Hello there, and welcome. I'm so glad you found your way here tonight. Before we begin, take a moment to get comfortable. Adjust your pillow. Let your body settle into whatever position feels right. There's no rush. We have all the time in the world. Tonight we're going to explore one of the most extraordinary moments in modern financial history, September 16th, 1992, the day a single investor made $1 billion in 24 hours by betting against the Bank of England. We'll discover the reality behind the legend of the man they called the man who broke the Bank of England, understand the philosophy that shaped his thinking, and slowly, carefully, piece together how markets, currencies, and human psychology collided on that autumn day in London. But don't worry, this isn't going to be a frantic thriller about financial speculation. Instead, we'll move slowly and thoughtfully through George Soros' life, through the ideas that shaped him, through the trade itself, and through what it all meant. By the end, I think you'll find this story is about much more than money. It's about understanding uncertainty, testing ideas against reality, and the limits of both markets and governments. If you drift away, that's perfectly fine. That's what we're here for. So settle in, let your shoulders drop, take a slow breath, and let's begin. Let's begin in Budapest in the summer of 1944, when a 13-year-old boy named George Soros learned the most important lesson of his life, a lesson about survival, about the gap between appearance and reality, about how the world can transform overnight into something unrecognizable. George Soros was born Georgi Schwartz on August the 12th, 1930, in Budapest, Hungary, into a comfortable middle-class Jewish family. His father, Tivadar Soros, was a lawyer and writer who had survived the First World War and years in a Russian prison camp during the Russian Revolution. That experience had taught Tivadar something profound about survival, about resourcefulness, about the importance of understanding when normal rules no longer applied. He would need to use those lessons to save his family. Budapest in the early 1930s and through the late 30s was a sophisticated, cultured city. One of the jewels of Central Europe, the Soros family lived well. Young George attended good schools, enjoyed a comfortable childhood, seemed destined for a conventional professional life. But underneath this surface normalcy, something terrible was building. Hungary had aligned itself with Nazi Germany. Anti-Semitic laws were passed, restricting Jewish life and opportunity. And when Germany occupied Hungary in March of 1944, the situation became catastrophic almost overnight. What happened next would shape everything about how George Soros understood the world. His father, Tivadar, immediately grasped that the normal rules of society had collapsed, that the institutions and laws that had previously protected people were now instruments of destruction. He understood that survival required acting quickly, thinking clearly, and abandoning any assumption that things would somehow return to normal. This was the lesson he passed to his son. Tivadar obtained false identity papers for his family. The Schwartz family ceased to exist, at least on paper. They became different people with different names, different backgrounds, different stories. George was placed with a Hungarian government official who posed as his godfather. The official's job was to inventory confiscated Jewish property, an ugly task, collaborating with the Nazi occupation, but one that provided cover. Young George sometimes accompanied him on these inventories, seeing abandoned homes, possessions left behind by families who had been deported. He was witnessing the destruction of his community while pretending to be someone else entirely, living a lie that kept him alive. This experience, living under a false identity, watching the collapse of civilization, surviving through deception and adaptability, taught George several crucial lessons. First, that reality is often very different from what it appears to be. The normal, comfortable world of his early childhood had been revealed as fragile, temporary, subject to sudden, violent disruption. Second, that survival sometimes requires abandoning conventional morality and thinking in purely practical terms. His father's decision to obtain false papers, to lie, to manipulate the system was morally necessary, even though it violated normal rules. Third, that understanding when rules have changed is more important than understanding the rules themselves. His father's great insight was recognizing that the old world had ended and new strategies were needed. The Soros family survived. Not all their relatives did. George lost extended family members in the Holocaust. But the immediate family made it through the Nazi occupation and the brutal siege of Budapest in the winter of 1944 to 1945, when Soviet forces fought to take the city from German defenders. George witnessed the final collapse of the Nazi regime and the arrival of Soviet forces, which brought liberation from one totalitarian system, but the beginning of another. Post-war Budapest fell under Soviet control. Hungary became a communist state, a satellite of the Soviet Union. For Tivadar Soros, this was intolerable. He had survived the Nazis. He had no intention of living under another totalitarian system. In 1947, he helped arrange for 17-year-old George to leave Hungary and make his way to England. It was a difficult journey. George travelled through various countries with minimal resources, relying on his wits and his father's training and survival. But he made it to London, arriving with almost no money, speaking limited English, knowing no one, but carrying the lessons his father had taught him about adaptation and survival. London in 1947 was still recovering from the war. Rationing continued. The city bore the scars of the Blitz. It was not an easy place for a Hungarian refugee with no money and few connections. George Soros lived in poverty, working odd jobs while trying to continue his education. He enrolled at the London School of Economics, one of the world's leading institutions for social sciences, supporting himself through a combination of work and small scholarships. The work was sometimes demeaning. He worked as a railway porter, as a travelling salesman of handbags, in various other low-wage jobs that allowed him to eat and pay for a tiny room while attending classes. At the London School of Economics, George encountered the philosopher Karl Popper, and this encounter would shape his intellectual framework as profoundly as his father's survival lessons had shaped his understanding of reality. Popper was not his direct teacher. Popper had left LSE for a position elsewhere by the time George arrived, but Popper's ideas dominated the intellectual atmosphere of the school, and George immersed himself in Popper's writings and philosophy. Karl Popper's central idea, the idea that would become foundational to how George Soros thought about everything from markets to politics to knowledge itself, was fallibilism. Fallibilism is the recognition that all human knowledge is imperfect, provisional, subject to error. We can never be certain we understand reality correctly. Our theories, our models, our beliefs are always potentially flawed. The best we can do is test them against reality, remain open to being wrong, and revise our understanding when evidence contradicts our theories. This might sound like a recipe for paralysis or relativism, but for Popper and later for Soros, it was actually liberating and practical. Popper distinguished between what he called open societies and closed societies. Closed societies were based on claims to absolute knowledge, ideologies, whether fascist or communist or religious fundamentalist, that claimed to understand the ultimate truth about how society should be organized and refused to tolerate dissent or allow testing of their claims. Open societies, in contrast, were based on the recognition of fallibility. They allowed freedom of thought, criticism, testing of ideas, revision of policies based on evidence. Democracy, free markets, free speech. These institutions reflected the recognition that no one has a monopoly on truth, that we need systems for testing ideas and peacefully correcting mistakes. For George Soros, who had lived under both Nazi and communist totalitarianism, who had witnessed the catastrophic consequences of ideologies that claimed absolute certainty, Popper's philosophy resonated deeply. It connected his lived experience to an intellectual framework. The Nazis had been certain they understood race and history. The communists were certain they understood economics and social development. Both certainties had led to enormous suffering. Popper offered an alternative: embrace uncertainty, test ideas rigorously, remain always open to being wrong, build institutions that allow peaceful error correction. But Popper's philosophy wasn't just about politics and society. It was fundamentally about epistemology, about how we know what we know, and more importantly, about the limits of knowledge. Popper argued that we can never prove a theory is true. We can only prove theories are false. A scientific theory might be consistent with all the evidence we've gathered so far. But that doesn't mean it's correct. It means only that we haven't yet found evidence that contradicts it. The best theories are those that make bold, testable predictions that could potentially be falsified. When we test those predictions and they hold up, our confidence increases, but we never reach certainty. And when evidence contradicts our theory, we must abandon or revise it, no matter how attached we are to it. This approach to knowledge would later become central to how Soros thought about financial markets. Markets, like any human endeavour, are filled with uncertainty. Participants in markets form theories about how the world works, about what companies or currencies are worth, about what will happen next. But those theories are always imperfect, always potentially wrong. The best approach isn't to seek certainty but to form testable hypotheses. Take positions based on those hypotheses, remain alert to evidence that you might be wrong, and be willing to change your mind when reality contradicts your expectations. Hold your beliefs lightly, be prepared to be wrong. Survival and success come not from being right, but from correcting your errors faster than others correct theirs. George Soros graduated from the London School of Economics in 1952 with a degree in philosophy. He wanted to pursue an academic career to continue thinking about these big questions about knowledge and society, but he needed to make a living. His attempts to find academic positions failed. He was a Hungarian refugee without connections, and his ideas were seen as too abstract, not fitting neatly into existing academic categories. Philosophy jobs were scarce. He needed work. So he entered finance somewhat by accident, somewhat by necessity. He found work in the City of London, London's financial district, at various merchant banks and brokerage firms. The work was not intellectually stimulating at first. He was doing arbitrage, buying and selling securities in different markets to exploit small price differences, and helping wealthy clients invest their money. It was practical, somewhat tedious work that seemed far removed from the philosophical questions that interested him. But he was learning how markets worked, how information flowed, how prices were set, how people made decisions under uncertainty. And slowly he began to see connections between the philosophical ideas he had studied and the practical reality of financial markets. Markets, he noticed, were not the rational, efficient systems that economic theory described. They were filled with people making decisions based on imperfect information, influenced by emotions and biases, reacting to each other's reactions in ways that created patterns and movements that had little to do with underlying economic fundamentals. The price of a stock or a currency at any given moment reflected not some objective value, but the collective beliefs and expectations of market participants, and those beliefs were always partially wrong, always subject to revision, always influencing the very reality they were trying to understand. This would later become his theory of reflexivity, but in the 1950s in London, it was just an observation, a puzzlement, a sense that the world of finance might be a laboratory for testing ideas about knowledge and reality. In 1956, George Soros left London for New York. He was 25 years old, still not wealthy, still not particularly successful, but carrying with him a unique combination of experiences and ideas, survival under totalitarianism, Popper's philosophy of fallibilism and open society, and growing understanding of how financial markets actually operated as opposed to how theory said they should operate. New York in the 1950s was becoming the centre of global finance, replacing London as the world's financial capital. It was a place of opportunity for someone willing to work hard, think independently and take risks. George Soros was all of those things. He found work at FM Mayer, a small investment bank, doing arbitrage in European securities, buying stocks in one market and selling them in another when prices diverged. The work was similar to what he'd done in London, but New York offered something London did not: scale, dynamism, the sense that anything was possible. The American financial system was larger, more liquid, more open to new ideas and new people than the more traditional class-bound British system. Soros was still an outsider, Hungarian accent, limited connections, no wealth. But in America, those things mattered less than in Europe. What mattered was whether you could make money, whether you understood opportunities others missed, whether you could deliver results. And slowly, gradually, through the late 1950s and early 1960s, George Soros began to demonstrate that he could do exactly that. He was beginning to develop a track record, beginning to understand not just how markets worked, but how to profit from that understanding. His philosophical training in thinking about uncertainty, his survival training in recognizing when normal assumptions no longer applied, and his practical experience in markets were coming together. The foundation was being built for what would eventually become one of the most successful investment careers in history, though in 1956, no one, including Soros himself, could have predicted that future. He was simply a young immigrant trying to make his way in a new country, carrying ideas and experiences that would eventually prove extraordinarily valuable, even if their value was not yet apparent. Through the 1960s, George Soros worked at various investment firms in New York, gradually building a reputation as someone who understood European markets better than most American analysts. He was doing well, not spectacularly but competently, making money for his employers by finding mispriced securities, exploiting his knowledge of European companies and markets that other American investors didn't understand as deeply. But he was working for others, implementing their strategies within their constraints, earning a salary and small bonuses rather than sharing significantly in the profits his insights generated. He was good at what he did, but he wasn't yet doing it for himself. In 1969, at age 39, George Soros took the step that would transform his career. He founded his own investment fund, initially called First Eagle Fund, later renamed Double Eagle Fund. He started with $4 million in capital, raised from a handful of wealthy investors who were willing to take a chance on a relatively unknown Hungarian immigrant with unconventional ideas about how markets worked. $4 million sounds substantial, and it was, but in the world of institutional investing it was quite modest. Soros was starting small, but he was finally working for himself, able to implement his ideas without compromise, able to take the kinds of positions and risks that his philosophy and analysis suggested were appropriate. Crucially, he brought in a partner, Jim Rogers, a young analyst from Alabama who shared Soros's appetite for intensive research and unconventional thinking. Rogers was brilliant, driven, and willing to work extraordinarily hard digging into companies, industries, and economic trends. The partnership worked because their skills complemented each other. Soros was the philosopher, the big-picture thinker, the one who synthesized information into theories about how markets would move. Rogers was the researcher, the detective, the one who would spend weeks investigating a single company or industry, traveling to factories, talking to competitors and customers, gathering the detailed information that turned theories into actionable investments. Together, they formed a formidable team. The investment approach they developed was unusual for the time. Most investment funds focused on picking individual stocks within a single country, usually the United States. They would research companies, decide which were undervalued or had good prospects, buy those stocks and hope they went up. It was fundamentally a micro approach, focused on individual companies and their specific circumstances. Soros and Rogers did some of that, but they also took a macro approach, thinking about entire economies, entire sectors, currencies, commodities, interest rates. They were willing to invest anywhere in the world in any asset class if their analysis suggested an opportunity. This global macro investing, as it would later be called, was rare in the late 1960s and early 1970s. Most investors stayed within familiar territory, within their own country. Within traditional asset classes, the 1970s provided the perfect environment for this approach, though perfect is perhaps the wrong word. It was turbulent, confusing, painful for most investors, but filled with opportunities for those who could navigate the chaos. Let's think about what was happening in the world economy during this decade. It was a period of extraordinary disruption, when many of the assumptions that had guided economic policy and investment since the Second World War were being challenged and overturned. First came the collapse of the Bretton Woods system, the framework of fixed exchange rates that had governed international currency relationships since 1944. Under Bretton Woods, currencies were pegged to the dollar, and the dollar was convertible to gold at $35 per ounce. This system had provided stability but was becoming unsustainable as the United States ran large budget deficits to finance the Vietnam War and Great Society programs. In August 1971, President Richard Nixon ended dollar convertibility to gold, effectively ending the Bretton Woods system. Currencies began to float against each other, their values determined by market forces rather than fixed pegs. This created volatility, uncertainty, and opportunity for investors who could understand and predict currency movements. Then came the oil shocks. In October 1973, Arab oil producers imposed an embargo in response to the Yom Kippur War, and oil prices quadrupled almost overnight. Suddenly, the cheap energy that had fueled post-war economic growth was expensive and uncertain. Economies that depended on imported oil faced enormous new costs. Inflation accelerated. And then in 1979, the Iranian Revolution disrupted oil supplies again, and prices doubled once more. The oil shocks transformed the global economy, benefiting oil producers while punishing oil consumers, creating inflation everywhere, forcing central banks and governments to make difficult choices. The 1970s saw the emergence of something economists had thought impossible: stagflation, the combination of economic stagnation and inflation. Traditional economic theory suggested you got either inflation or unemployment, not both. When the economy was strong and growing, inflation might rise but unemployment would fall. When the economy was weak, unemployment would rise but inflation would fall. But in the 70s, both inflation and unemployment were high simultaneously. The old policy tools didn't work. When central banks raised interest rates to fight inflation, they worsened unemployment. When governments tried to stimulate the economy to create jobs, they worsened inflation. It was an economic puzzle that policymakers struggled to solve. For most investors, the 70s were miserable. The stock market went nowhere. The Dow Jones Industrial Average in 1982 was barely higher than it had been in 1965, despite 17 years passing. When you adjusted for inflation, stock market returns were deeply negative. Traditional 60-40 portfolios, 60% stocks, 40% bonds, lost money in real terms. It was a lost decade for conventional investing, a time when simply holding stocks and bonds and waiting for them to go up, the strategy that had worked for decades, produced disappointing results. But for Soros and Rogers, the 70s were extraordinary. The chaos, the volatility, the breaking of old patterns. This was exactly the environment where their approach thrived. They weren't committed to any particular asset class or country. They could invest in oil stocks when oil prices were rising, short stocks when they thought markets would fall, buy currencies they thought would appreciate, invest in commodities like gold when inflation was accelerating. They were nimble, flexible, willing to change their minds when circumstances changed. Let me give you a sense of how they worked. Rogers would research intensely, reading industry publications, visiting companies, talking to experts, gathering information from dozens of sources. He was famous for his willingness to dig deeper than anyone else, to understand not just a company but its entire industry, its suppliers, its customers, the regulatory environment, the competitive dynamics. He would produce detailed memos laying out what he'd learned. Soros would read these memos, synthesize the information, think about what it meant for broader market trends, and decide on positions. The decision-making was ultimately Soros's. It was his fund, his capital at risk. But Rogers's research was crucial to informing those decisions. Their returns through the 70s were remarkable. WWII Fund, later renamed Quantum Fund when they reorganized in 1973, generated annual returns that averaged roughly 30% through the decade. Think about what that means. Most investors were losing money in real terms, struggling to keep up with inflation, watching their portfolios stagnate or decline. Soros and Rogers were compounding at 30% annually. $4 million growing at 30% per year for a decade becomes over $50 million. Investors who had put money with Soros at the beginning saw their wealth multiply many times over. And as word spread about these extraordinary returns, more investors wanted in, providing Soros with more capital to deploy. The fund's success rested on several factors. First, the research was genuinely better than what most investors were doing. Deeper, more thorough, more global in perspective. Second, the willingness to invest anywhere, in any asset class, meant they could always find opportunities even when traditional markets were struggling. Third, the philosophical framework, Popper's fallibilism. The recognition that all beliefs are provisional meant they weren't married to their positions. When evidence suggested they were wrong, they got out. They took losses when necessary, but they kept losses small and let winners run. Fourth, they used leverage, borrowing money to magnify their positions, which amplified both gains and risks, but which they managed reasonably well. But success created tensions. By the late 1970s, Soros and Rogers had made a great deal of money, both for their investors and for themselves. The partnership that had been so productive was beginning to strain. Part of the tension was about credit. Rogers felt he wasn't receiving sufficient recognition for his contributions, that the public narrative focused too much on Soros as the investment genius, while Rogers did much of the hard work. Part was about control. Soros made final decisions, and Rogers sometimes disagreed with those decisions. Part was simply that they were both strong personalities who had achieved enough success that they no longer needed each other as they once had. In 1980, the partnership ended. Jim Rogers left Quantum Fund to pursue his own interests. He would later become famous for motorcycle trips around the world, for his own investing, for commentary and writing. The split was not entirely amicable, though both men later spoke respectfully of each other's abilities. For Soros, Rogers' departure meant he now had full control of Quantum Fund, but also full responsibility. He would need to develop his own research capability, make decisions without the intensive analytical support Rogers had provided. Some observers wondered if the fund's success would continue without Rogers. The answer would prove to be yes. In fact, Soros's most successful years were still ahead of him. Through the 1980s, Quantum Fund continued to produce extraordinary returns. The 80s were different from the 70s. Instead of stagflation and chaos, there was the beginning of what would be called the Great Moderation, a period of more stable growth, declining inflation, rising asset prices. The stock market boomed, with the Dow Jones rising from under 1,000 at the start of the decade to over 2,000 by the end. Interest rates, which had peaked at extraordinary levels in the early 80s as Federal Reserve Chairman Paul Volcker fought inflation, began a long decline. This created a powerful tailwind for investors. Falling interest rates meant rising bond prices and higher stock valuations. It was a much more favourable environment for conventional investing than the 70s had been. But Soros wasn't a conventional investor. He continued taking large, concentrated positions based on his analysis of macroeconomic trends. He would build substantial positions in currencies, betting billions on his view of whether a currency would rise or fall. He would invest heavily in particular sectors or countries when he believed he understood something the market didn't. And he would use significant leverage, sometimes borrowing several times the fund's capital, to magnify positions he had strong conviction about. This approach created the possibility of spectacular returns, but also spectacular losses. It required enormous confidence in one's analysis and strong nerves when positions moved against you, as they inevitably sometimes did. The fund did experience setbacks. There were quarters when they lost money, sometimes substantial amounts. But the gains in winning periods more than compensated for the losses in losing periods. Over the course of the 1980s, Quantum Fund produced average annual returns of roughly 35%, even better than the already impressive returns of the 70s. An investor who'd put $100,000 into Quantum Fund in 1970 would have several $1 million by 1990. Soros himself became extraordinarily wealthy, not just comfortable, but one of the richest people in the world, with wealth measured in billions of dollars. During this period, Soros was also beginning to articulate his investment philosophy more explicitly, to move beyond simply doing it to explaining how and why it worked. In 1987, he published The Alchemy of Finance, a book that laid out his theory of reflexivity and attempted to show how this theory had guided his investment decisions. The book was unusual, part investment memoir, part philosophical treatise, part real-time experiment where Soros shared his thinking process during a specific period of managing the fund. It was not an easy read, and many people in finance found it too abstract, too philosophical. They wanted concrete tips and strategies, not epistemological musings about the nature of knowledge and reality. But for those willing to engage with the ideas, the book offered insight into how a truly successful investor actually thought about markets. Personally, Soros married twice during these decades. His first marriage, to Anneliese Wittschak in 1960, produced 3 children, but ended in divorce in 1983. He remarried in 1983 to Susan Weber, and they would have 2 children together before that marriage, too eventually ended in divorce. His personal life was complicated, marked by the same intensity and drive that characterized his professional life. He was not, by his own admission or by accounts from those who knew him, an easy person to live with. He was consumed by his work, by his thinking, by the markets. He could be charming and engaging, but also demanding and difficult. The same qualities that made him a successful investor, relentless focus, unwillingness to accept conventional wisdom, constant questioning, did not necessarily make him easy to be close to. By the end of the 1980s, as we approached 1990, George Soros had established himself as one of the most successful investors in the world. Quantum Fund had a 20-year track record of extraordinary returns. Soros had accumulated enormous wealth. He had begun to articulate a philosophical framework that explained his approach, but in some ways, his greatest trade, the trade that would make him not just successful but famous, that would transform him from a figure known within finance to a globally recognized name, was still ahead of him. The foundation had been built. The philosophical training, the survival instincts, the decades of experience in markets, the willingness to take large positions when conviction was strong. All of this would come together in September 1992 in a trade involving British sterling and the European exchange rate mechanism. But to understand that trade, we first need to understand the theory that guided it, the framework of reflexivity that Soros believed explained how markets actually worked. Let's slow down, take a breath, and turn to those ideas. To understand George Soros's approach to investing, to understand how he could make billion-dollar bets with such conviction, we need to explore the theory that guided his thinking, reflexivity. This is perhaps the most abstract part of our journey tonight, but it's also the most important for understanding how Soros saw the world. So let's take our time with these ideas. Let them unfold slowly. Think about them together. If your mind wanders or you drift off, that's perfectly fine. These are ideas to contemplate, not facts to memorize. Reflexivity, at its core, is a theory about the relationship between thinking and reality, between perception and truth, between what we believe and what actually is. It's a theory that challenges one of the fundamental assumptions of traditional economics, the idea that markets move toward equilibrium, that prices reflect underlying value, that reality exists independently of what people think about it. Let's start with how mainstream economics thinks about markets, because we need to understand what Soros was arguing against. The dominant theory in finance, developed over many decades and taught in every economics program, is called the efficient market hypothesis. This theory, in its various forms, suggests that market prices reflect all available information. When new information becomes available, prices adjust quickly to incorporate it. This means that at any given moment, the price of a stock or a currency or any traded asset represents the best possible estimate of its true value, given what is currently known. You can't consistently beat the market because any information you have, other people have too, and it's already reflected in the price. The efficient market hypothesis rests on a particular view of how the world works. It assumes that there is an underlying reality, fundamental values, that exist independently of what market participants think. A company has actual assets, actual earnings, actual future prospects. These fundamentals determine what the company is really worth. Market participants try to understand these fundamentals, and while they might sometimes be wrong, their collective wisdom, aggregated through market prices, produces a reasonably accurate estimate. The market might be wrong for brief moments, but it can't be systematically wrong for long periods, because smart investors would notice the discrepancy and trade on it, pushing prices back toward fundamental value. This is a comforting theory because it suggests markets are rational, self-correcting, fundamentally sound. It implies that prices mean something, that they reflect reality, that we can trust market signals. It's also a theory that makes markets similar to natural sciences. In physics, there are underlying realities, the mass of an object, the speed of light, that exist whether humans observe them or not. Scientists develop theories to understand these realities, and while theories might be imperfect, the reality itself remains independent. The efficient market hypothesis suggests markets work the same way. There are underlying values, and prices are attempts to measure those values. Just as scientific instruments measure physical quantities, George Soros believed this was fundamentally wrong. Not just slightly wrong, or wrong in technical details, but wrong in its basic conception of how markets work. And his alternative theory, reflexivity, started from Karl Popper's philosophy, but extended it in directions Popper himself didn't fully explore. Remember from our earlier discussion that Popper distinguished between natural sciences and social sciences. In natural sciences, i.e. the objects of study, planets, chemicals, atoms, don't care what scientists think about them. Your theory about gravity doesn't affect how gravity works. But in social sciences, including economics, the objects of study are people, and people think. Their thinking affects their behaviour, which affects the outcomes you're trying to study. This creates a fundamental difference between natural and social phenomena. Soros took this insight and developed it into a theory of how markets actually operate. He started with the observation that market participants are trying to understand a reality that they are simultaneously helping to create. You're not just an observer trying to measure something external to you. You're a participant whose actions affect the thing you're trying to understand. This creates a feedback loop, a reflexive relationship between thinking and reality. Let's think about this carefully because it's subtle. In a market, participants form views about what assets are worth. Those views are based on their understanding of fundamentals, what a company earns, what an economy produces, what a currency's purchasing power is. Based on those views, they make decisions, buying or selling. Those decisions determine prices. And here's the crucial point. Those prices then affect the fundamentals themselves. The connection goes both ways. Thinking influences reality, which influences thinking, which influences reality in a continuous loop. Let me give you a concrete example. Imagine a company whose stock price is rising. Why is it rising? Maybe because investors believe the company has good prospects. As the stock price rises, several things happen. The company can issue new shares at the higher price, raising cheap capital. With that capital, it can invest in expansion, research, acquisitions. Its higher stock price makes it easier to attract talented employees through stock options. Its apparent success attracts customer attention and confidence. All of these factors, cheap capital, good employees, customer confidence, actually improve the company's fundamentals. They make the company more valuable. So the initial belief that the company was valuable, even if it was somewhat disconnected from reality at the start, becomes self-fulfilling. The thinking changes the reality to match the thinking. The same process works in reverse. If a company's stock price falls, raising capital becomes expensive or impossible. Talented employees leave for companies with rising stock prices. Customers become nervous. Suppliers demand stricter payment terms. The company's fundamentals actually deteriorate. The belief that the company is in trouble becomes self-fulfilling. This is reflexivity, the two-way connection between perception and reality, between thinking and being. Participants' views influence the situation, and the situation influences participants' views. Neither is independent of the other. There's no stable equilibrium where price equals fundamental value, because fundamental value itself is partially determined by price. The feedback loop is always operating. Soros distinguished between two functions that participants in markets perform. First, they have a cognitive function, trying to understand reality, forming views about what's happening. Second, they have a participating function, taking actions based on those views, which affect the reality they're trying to understand. In natural sciences, only the cognitive function exists. Scientists observe and theorize, but their observing doesn't change what they're observing. In markets, both functions are always operating simultaneously, and they interfere with each other, because participants are simultaneously trying to understand and trying to act. And because their actions affect what they're trying to understand, perfect understanding is impossible. You can never achieve the objective God's eye view that would allow you to know true fundamental value, because there is no true fundamental value independent of what participants believe and do. Soros called this the _quote_for_, the inherent inability of participants to achieve perfect knowledge of the situations they're participating in. Now you might think this leads to chaos, to complete unpredictability. If everything affects everything else in feedback loops, how can you understand or predict anything? But Soros argued that reflexivity creates patterns, identifiable sequences that repeat, even though the specific details differ each time. He called these boom-bust sequences, and understanding them was central to his investing. A boom-bust sequence typically unfolds like this. It starts with a trend, maybe a new technology, a new policy, a change in economic conditions. Participants notice this trend and form a theory about what it means. Based on that theory, they take actions, buying stocks, making investments, taking risks. Those actions reinforce the trend, making it stronger. This reinforces the participants' belief that their theory is correct, leading to more enthusiastic participation. Prices rise, fundamentals improve, beliefs strengthen in a self-reinforcing cycle. This is the boom phase. But here's the crucial point. The boom is based on a misconception, on a theory that exaggerates the significance of the trend or misunderstands its sustainability. The initial insight might have been valid, but the self-reinforcing process carries prices and fundamentals far beyond what the original insight justified. The trend becomes unsustainable, but momentum keeps it going for a while. Eventually, reality reasserts itself. Maybe the fundamentals can't keep improving. Maybe prices reach levels where even optimistic participants hesitate. Maybe some external event breaks the spell. When the trend falters, the process reverses. Declining prices weaken fundamentals. Weakening fundamentals justify lower prices. Beliefs shift from optimism to pessimism. The self-reinforcing cycle now operates in reverse. This is the bust phase. The boom-bust pattern isn't inevitable or mechanical. Sometimes trends are sustainable and don't lead to busts. Sometimes corrections are gentle rather than catastrophic. But the pattern recurs frequently enough that recognizing where you are in the cycle, whether in the self-reinforcing boom phase, the vulnerable peak, or the cascading bust, can guide investment decisions. Soros believed that by understanding reflexivity, by recognizing these patterns, by identifying the misconception that was driving a particular boom, you could position yourself to profit from the eventual correction. This theory had profound implications for how Soros invested. First, it meant he didn't trust market prices to reflect fundamental value. Prices reflect participants' biases, their misconceptions, the current state of the self-reinforcing or self-correcting process. Prices can diverge from any reasonable notion of fundamental value for extended periods. Second, it meant that understanding fundamentals wasn't enough. You also needed to understand what other participants believed, how those beliefs were affecting fundamentals, where you were in the boom-bust sequence. Third, it meant that extreme situations, when trends had become most pronounced, when beliefs were most one-sided, when everyone seemed convinced of the same story, were often the best opportunities, because those were the moments when reality was most likely to reassert itself in ways that would surprise the crowd. Soros also believed that reflexivity operated beyond markets, that it was a general feature of social phenomena. Political systems, social movements, historical events, all involved people trying to understand situations they were part of, and their understanding affected the situations. The fall of the Soviet Union, which Soros witnessed and in some ways participated in through his support for democratic movements, was a reflexive process. People's belief that the system could change made change possible, and each small success strengthened belief in the possibility of further change, until the entire system collapsed. Historical events weren't just the product of underlying forces, but of how people understood and reacted to those forces. This might all sound quite abstract, perhaps even impractical. How does a theory about feedback, loops, and participant bias translate into actual investment decisions? For Soros, it meant several things in practice. It meant being willing to hold contrarian positions when he believed the market consensus was based on a misconception. It meant looking for situations where a trend had gone too far, where the gap between reality and perception had become too large. It meant understanding not just what was happening, but what people thought was happening and how that thought was affecting what actually happened. It meant being alert to tipping points, moments when the self-reinforcing process might reverse. It also meant being willing to be wrong and change his mind quickly. If reflexivity meant that perfect knowledge was impossible, that all theories were provisional, then holding on to losing positions because of stubborn conviction was foolish. The proper approach was to form a hypothesis, test it by taking a position, watch carefully to see if events unfolded as expected, and be ready to reverse course if they didn't. Soros was famous, or perhaps notorious, for changing his mind, sometimes dramatically and quickly. A position he had argued for passionately one day might be abandoned the next if new information suggested the thesis was wrong. This wasn't inconsistency or lack of conviction. It was the logical application of fallibilism, the recognition that being less wrong mattered more than being right. The theory of reflexivity was never fully accepted in academic finance. Most economists remained committed to equilibrium theories, to the idea that markets are fundamentally efficient even if they're occasionally irrational. Soros's theory seemed too vague, too dependent on subjective judgment, too difficult to test rigorously. How do you measure participant bias? How do you identify a misconception in real time? How do you know when you're in a boom phase rather than a justified upward trend? The critics had a point. Reflexivity wasn't a precise mechanical theory that generated clear predictions. It was a framework, a way of thinking, a set of patterns to watch for. But for Soros, the proof was in the results. His track record, the actual returns generated over decades, suggested that whatever he was doing worked. Maybe the theory was imperfect. Maybe it couldn't be formalized into elegant mathematical models, but it captured something true about how markets actually operated. It explained why markets went through manias and panics, why prices diverge from fundamentals, why conventional analysis often failed, and most importantly, it provided a framework for thinking about when to take large positions, when to be bold, when to bet that the market was wrong and he was right. As we move forward in our story, as we approach the trade that would make Soros famous, keep this theory in mind. The bet against the British pound in 1992 was an application of reflexivity. It was Soros recognizing a situation where political will was trying to maintain a trend, a fixed exchange rate, that was unsustainable, where the misconception was the belief that political commitment could override economic reality, where a self-reinforcing process was about to reverse. But to understand that trade fully, we need to understand what the European exchange rate mechanism was, why Britain joined it, and why it created the perfect conditions for a reflexive crisis. Let those thoughts rest for now. We'll return to them soon, but first let your mind settle. Let the ideas about reflexivity drift through your thoughts like clouds across a quiet sky. To understand what happened in September 1992, we need to step back and understand the system that George Soros would eventually bet against. The European exchange rate mechanism. This was a monetary arrangement, a set of rules about how European currencies would relate to each other, and it was created with the best of intentions, with serious economic logic, and with enormous political commitment. But it was also, as Soros would recognize, exactly the kind of system that reflexivity theory suggested was vulnerable to crisis. Let's explore this carefully, understanding both why it made sense and why it was fragile. The European exchange rate mechanism, usually just called the ERM, was established in 1979 as part of the European monetary system. To understand why it existed, we need to think about the broader project of European integration that had been unfolding since the end of the Second World War. Europe had torn itself apart in two catastrophic wars within 30 years. The destruction had been unimaginable. Tens of millions dead, entire cities destroyed, economies shattered, societies traumatized. In the aftermath, European leaders faced a question. How do you prevent this from happening again? How do you create lasting peace on a continent that had known mostly war for centuries? The answer they arrived at was integration, binding European countries together economically and politically so tightly that war between them would become not just undesirable but impossible. If France and Germany's economies were deeply intertwined, if their futures were linked, if their institutions were integrated, then conflict between them would be self-destructive. This was the logic behind the European Coal and Steel Community in 1951, the European Economic Community in 1957, and the steady expansion of European cooperation through the following decades. By the 1970s and 80s, European integration had progressed substantially. Trade barriers between member countries had been largely eliminated. Workers could move freely across borders. Regulations were being harmonized. But there was still a major barrier to complete economic integration: different currencies. Each European country had its own currency, and exchange rates between them fluctuated, sometimes dramatically. This created uncertainty and costs for businesses operating across borders. If you were a French company selling to Germany, you had to worry about whether the franc would strengthen or weaken against the Deutschmark between when you agreed to a price and when you received payment. Currency fluctuations could turn profitable deals into losses. More fundamentally, having different currencies meant having different monetary policies. Each country's central bank could set its own interest rates, control its own money supply, pursue its own inflation targets. This monetary independence was valuable. It allowed each country to respond to its specific economic conditions. But it also meant that countries could pursue policies that hurt their neighbours. A country could devalue its currency to make its exports cheaper, gaining competitive advantage but imposing costs on trading partners. This was sometimes called competitive devaluation or beggar-thy-neighbour policy, and it created friction and instability. The European monetary system and its centrepiece, the exchange rate mechanism, were designed to address these problems. The ERM would create stable exchange rates between European currencies, while countries still maintained their own currencies and central banks. It was conceived as a stepping stone toward eventual monetary union, a single currency, but in the meantime it would provide the benefits of currency stability. Here's how the ERM worked, and please follow this carefully, because understanding the mechanics is important for understanding what went wrong. Each currency in the system had a central parity rate against the other currencies. For example, the British pound might be set at 2.95 Deutschmarks, the French franc at 3.35 Deutschmarks, and so on. These were the official rates, the target rates that were supposed to reflect the appropriate economic relationship between the currencies. But the system recognized that perfect stability was impossible. Economic conditions change, trade flows shift, inflation rates differ. So instead of requiring currencies to remain exactly at their central parity rates, the system allowed fluctuation within a band. Originally, most currencies could fluctuate 2.25% above or below their central parity rate. Later, this was widened to 6% for some currencies. This provided some flexibility while still maintaining overall stability. The crucial mechanism for maintaining the system was central bank intervention. If a currency approached the edge of its permitted band, if it was getting too weak or too strong, the central banks were obligated to intervene. The central bank of the weak currency would buy its own currency using its reserves of foreign currency, creating demand and pushing the price up. The central bank of the strong currency would sell its currency, increasing supply and pushing the price down. Both central banks were supposed to act together to keep currencies within the bands. There was also a tool of last resort: interest rates. If currency intervention wasn't sufficient, countries could adjust their interest rates. Raising interest rates makes a currency more attractive to international investors because they can earn higher returns, so it tends to strengthen the currency. Lowering rates has the opposite effect. This gave countries another tool for staying within the ERM bands. Now, why would countries want to join this system? What were the benefits that made them willing to give up some monetary independence? First, there was the stability benefit we already discussed. Predictable exchange rates made trade and investment easier. Second, and perhaps more important politically, there was the disciplinary benefit. By tying your currency to the Deutschmark, which was anchored by the famously inflation-averse German Bundesbank, you imported Germany's monetary credibility. If your country had a history of inflation, if your central bank wasn't fully trusted, joining the ERM and committing to maintaining a fixed rate against the Deutschmark was a way of borrowing Germany's reputation. It signalled to markets and to your own population that you were serious about controlling inflation. Third, joining the ERM was seen as a political commitment to European integration. If you wanted to be part of the core of Europe, if you wanted to participate in decision-making about Europe's future, you needed to be in the ERM. It was a club, and being outside it meant being marginalised. For countries that saw their future as fundamentally European, this was a powerful motivation. The Deutschmark became the anchor of the system, the currency that others oriented around, because Germany had the strongest economy and the most credible central bank. The Bundesbank, created after World War II and given complete independence from political control, had a single overriding mandate: control inflation. This obsession with inflation came from Germany's historical experience with hyperinflation in the 1920s, which had destroyed savings, destabilized society, and helped pave the way for Hitler. Germans were deeply, viscerally opposed to inflation, and the Bundesbank reflected that preference. It would raise interest rates whenever inflation threatened, regardless of political pressure, regardless of short-term economic pain. This made the Deutschmark a stable, hard currency that other central banks wanted to link to. But here was the fundamental problem, the structural fragility that would eventually create crisis. What worked for Germany didn't necessarily work for other countries. Germany might need high interest rates to control inflation. Another country might need low interest rates to fight recession. But if you were in the ERM, you couldn't diverge too far from German rates without your currency coming under pressure. The system effectively meant that German monetary policy was imposed on all member countries, whether it fit their economic situations or not. This brings us to Britain, whose relationship with the ERM and with Europe more broadly was always complicated, always ambivalent. Britain had joined the European Economic Community in 1973, much later than the original members, and only after long debate about whether British interests were better served inside or outside European structures. There was always a tension in British politics between those who saw Britain's future as fundamentally European, and those who saw Britain as distinct, as having global ties through the Commonwealth, as having a special relationship with the United States, as being geographically part of Europe but not culturally or politically fully European. When the ERM was created in 1979, Britain chose not to join. Margaret Thatcher, who became Prime Minister that year, was sceptical. She valued British sovereignty, British independence, and was reluctant to tie British monetary policy to European structures. Through the 1980s, Britain remained outside the ERM, while most other major European economies joined. This outsider status was both comfortable and uncomfortable. Comfortable because it preserved British independence, uncomfortable because it marginalised Britain in European discussions about monetary integration. By the late 1980s, a pressure was building for Britain to join. The European project was advancing. The Single European Act of 1986 was creating a true single market. Discussion was beginning about moving beyond the ERM to full monetary union, a single European currency. If Britain wanted to influence these developments, if it wanted to be at the table when decisions were made, it needed to be in the ERM. Thatcher resisted, but others in her government, particularly Chancellor of the Exchequer Nigel Lawson and Foreign Secretary Geoffrey Howe, pushed for membership. The disagreement contributed to political tensions that would eventually lead to Thatcher's fall from power in November 1990. John Major, who succeeded Thatcher as Prime Minister, was more sympathetic to European integration. In October 1990, Britain finally joined the ERM. The decision was presented as bringing stability, importing German anti-inflation credibility, and ensuring Britain's place at the heart of Europe. The entry rate was set at 2 Deutschmarks and 95 Pfennigs to the pound. This rate would become crucial because almost immediately there were questions about whether it was appropriate. Was the pound overvalued at 2.95 Deutschmarks? This was debated then, and remains debated. Some argued that the rate was too high, that it made British exports expensive and imports cheap, that it would create trade deficits and economic strain. Others argued the rate was reasonable given Britain's economic fundamentals. What's clear in retrospect is that the rate reflected political considerations as much as economic ones. The government wanted a rate that looked strong, that suggested confidence in the British economy, that didn't appear to be a devaluation. A lower entry rate might have been more sustainable economically, but it would have been seen as weakness, as admission that the pound wasn't worth as much as people thought. Britain entered the ERM with a band of plus or minus 6% around the central parity rate, wider than the 2.25% band that applied to core members. This gave more flexibility but still imposed substantial constraints. British interest rates would need to stay reasonably close to German rates. If rates diverged too much, capital would flow toward the higher-yielding currency, creating pressure that would require intervention or policy changes. For a brief period, ERM membership seemed to work. Inflation, which had been over 10% in 1990, began to fall as the government maintained tight monetary policy to defend the sterling's ERM rate. The system appeared to be delivering the promised benefits: stability, credibility, anti-inflation discipline. But economic growth was slowing. Britain was entering recession. Unemployment was rising. And this is where the fundamental contradiction became acute. Let's think about what was happening in Germany in the early 1990s, because German circumstances were driving German monetary policy, and German policy was effectively setting rates for the entire ERM system. In November 1989, the Berlin Wall fell. Within a year, East and West Germany had reunified. This was a moment of enormous historical significance, the peaceful resolution of the Cold War's division of Germany. But economically, reunification created serious challenges. East Germany's economy was backward, inefficient, built on obsolete Soviet-style planning. Its factories produced goods nobody wanted to buy at any price. Its infrastructure was decaying. Bringing East Germany up to West German standards would require massive investment. Building new infrastructure, modernizing industry, supporting unemployed workers during the transition. The German government chose to fund this largely through borrowing and through transfers from West to East. Essentially, West German taxpayers would subsidize East German reconstruction. This fiscal expansion, large government spending increases, was inflationary. More money was chasing German goods and services, pushing up prices. The Bundesbank, true to its mandate and its nature, responded by raising interest rates. High interest rates would slow the economy, reduce inflationary pressure, keep the Deutschmark strong. From the Bundesbank's perspective, this was exactly what the situation demanded. Germany was experiencing economic overheating from reunification, and monetary policy needed to cool things down. But what Germany needed was exactly the opposite of what Britain needed. Britain was in recession in the early 1990s. The economy was contracting, unemployment was rising, businesses were struggling. What Britain needed was lower interest rates to stimulate the economy, to encourage borrowing and investment, to ease the recession. But Britain was tied to the ERM, which meant British rates couldn't fall too far below German rates without the pound coming under pressure. This was the impossible situation that the ERM created. One interest rate policy for economies in very different situations. Germany needed high rates because of reunification boom. Britain needed low rates because of recession. But the system required them to maintain similar rates. Something would have to give. Through 1991 and into 1992, the tension grew. British interest rates stayed high to defend the ERM parity, even as the recession deepened. The government kept insisting that the commitment to the ERM was absolute, that the rate would be defended, that there would be no devaluation. This political commitment was seen as essential. If the government wavered, if it suggested the parity might change, currency speculators would attack immediately. So the rhetoric was always firm, always confident. We are committed to the ERM. The parity will be maintained. There is no alternative. But economic reality was pulling the other direction. The pound at 2.95 Deutschmarks was looking increasingly overvalued as the British economy weakened. Exports were struggling because British goods were expensive. The trade deficit was growing. Businesses were pleading for lower interest rates. The political costs of high unemployment and recession were mounting. Yet the government felt trapped by its European commitments, by its promises about the ERM, by the fear that backing down would create political humiliation and economic chaos. By the summer of 1992, the situation was becoming critical. Other currencies in the ERM were also under pressure. The Italian lira was weak. The Spanish peseta was struggling. Questions were being asked about whether the whole system could hold together. and currency traders, including George Soros, were beginning to study the situation carefully, looking for weakness, testing their theories about whether political will could really override economic fundamentals indefinitely. The stage was set. The structural contradictions were in place. The collision between political commitment and economic reality was approaching. All that remained was for the crisis to unfold. The year 1992 began with a sense of cautious optimism in Britain. The recession that had gripped the economy through 1990 and 1991 appeared to be bottoming out. There were tentative signs of recovery. Manufacturing output was stabilizing. Consumer confidence was beginning to improve slightly. Housing prices had stopped falling quite so precipitously. The government pointed to these green shoots as evidence that their policies were working, that maintaining the ERM commitment was worth the pain, that recovery was just around the corner. But underneath the official optimism, concerns were growing. British interest rates in early 1992 stood at 10.5%. This was extraordinarily high by historical standards for an economy in recession. Normally, when an economy is struggling, when unemployment is rising and growth is stagnant, central banks cut interest rates aggressively to stimulate activity. But Britain couldn't cut rates significantly because of the ERM constraint. German rates were even higher. The Bundesbank had pushed rates above 9% and showed no inclination to cut them. If British rates fell too far below German rates, the pound would weaken, potentially threatening its ERM parity. So rates stayed high, strangling the recovery before it could gain momentum. The Conservative government under Prime Minister John Major was in an uncomfortable position. Major had been elected in his own right in April 1992, winning an unexpected victory over Labour despite the recession. The victory had been narrow, and Major's political capital was limited. His government had staked enormous prestige on the ERM commitment. Joining the ERM had been presented as a cornerstone of economic policy, a commitment to monetary stability and European integration. Backing away from it would be seen as humiliating defeat, an admission that the policy had been wrong, a validation of critics who had warned against joining. Yet the political pressure was building from within the Conservative Party itself. Conservative members of Parliament, particularly those representing constituencies with high unemployment, were hearing from constituents who were suffering. Small businesses were going bankrupt. Homeowners were in negative equity. Their houses worth less than their mortgages. Unemployment was over 2.5 million, nearly 9% of the workforce, and the medicine being prescribed, high interest rates to defend the ERM parity, seemed to be making the patient sicker rather than curing the disease. Through the spring of 1992, the pound traded comfortably within its ERM band. Markets seemed to accept the government's commitment. There were no major speculative attacks, no dramatic interventions required. But this calm was somewhat deceptive. Beneath the surface, doubts were accumulating. Currency traders were beginning to ask questions. Was the pound genuinely worth 2.95 Deutschmarks? Could Britain really maintain interest rates high enough to defend this parity, given its economic situation? How long would the British public tolerate recession-level unemployment to defend a fixed exchange rate? In currency markets, these kinds of questions are dangerous. Once traders start doubting whether a fixed exchange rate can be maintained, the doubt itself can become self-fulfilling. If enough traders believe a currency will devalue, they sell it, creating the very pressure that forces devaluation. This is exactly the kind of reflexive process that George Soros had theorized about, the way perceptions shape reality, which then validates the perceptions. Then, on June 2nd, 1992, something happened that sent shockwaves through the European integration project. Denmark held a referendum on the Maastricht Treaty, the agreement that laid out the path toward European monetary union and closer political integration. The treaty had been signed in February by European leaders, but it required ratification by each member country. In Denmark, the government chose to put it to a public referendum. The expectation was that Danes would approve it, Perhaps not enthusiastically, but by a comfortable margin. European integration had been proceeding for decades with broad public support, or at least acquiescence. The Danish voters rejected the treaty, not by a large margin. 50.7% voted no, 49.3% voted yes, but a rejection nonetheless. This was shocking. It was the first time European publics had been given a direct say on the integration process and had said no. The rejection didn't kill the Maastricht Treaty. Other countries would still ratify it, and Denmark would eventually hold another referendum that passed. But it created uncertainty about the whole European project. If Danish voters rejected Maastricht, might voters in other countries do the same? Was the political consensus around European integration weaker than leaders had assumed? For currency markets, the Danish referendum created doubt about whether the path to monetary union would proceed as planned. If Maastricht was in trouble, if European integration was facing popular resistance, then the political will to maintain the ERM might weaken. Countries might be less willing to endure economic pain to maintain fixed exchange rates if the ultimate goal, monetary union, was uncertain. The referendum opened a crack in the facade of European solidarity, and currency traders immediately began probing that crack. The first currency to come under serious pressure was the Italian lira. Italy had deep structural economic problems, large government deficits, high public debt, persistent inflation. The lira had always been one of the weaker currencies in the ERM, often trading near the weak edge of its permitted band, requiring frequent intervention to maintain. In the wake of the Danish referendum, speculators began testing whether Italy could hold the line. The mechanics of attacking a currency are straightforward, though the scale can be enormous. If you believe a currency is overvalued and will eventually devalue, you borrow that currency, sell it for another currency, wait for the devaluation, then buy back the original currency at the lower price and repay your loan, pocketing the difference. Let's walk through this slowly because understanding it matters. Imagine you believe the Italian lira will devalue from its current rate of, say, 750 lira to the Deutschmark down to 800 lira to the Deutschmark. You borrow 1 billion lira from a bank. You immediately sell those lira for Deutschmarks at the current rate, receiving about 1.33 million Deutschmarks. You wait. If you're right, and the lira devalues to 800 to the Deutschmark, you can now buy back 1 billion lira for only 1.25 million Deutschmarks. You repay the loan of 1 billion lira, and you've made 80,000 Deutschmarks in profit minus interest on the loan and transaction costs. Scale this up to billions or tens of billions, and the potential profits become enormous. The beauty of this trade from a speculator's perspective is that the risk-reward ratio is asymmetric. Your downside is limited. If you're wrong and the currency strengthens instead of weakening, you lose the amount it strengthens plus costs. But in a system like the ERM, currencies can only strengthen so much because they're capped by the bands. The pound, for instance, could only rise 6% above its central parity before the Bank of England would intervene to prevent further strengthening. So your maximum loss is relatively bounded, but your upside is potentially unlimited. If the currency devalues and exits the ERM entirely, it might fall 10%, 15%, 20%. The potential profit is much larger than the potential loss. This asymmetry becomes even more favourable when you recognise that governments defending a fixed exchange rate are playing with finite resources. A central bank has a limited stock of foreign currency reserves that it can use to buy its own currency and support the price. Once those reserves are exhausted, the defence fails. Speculators, in aggregate, have access to effectively unlimited capital. They can borrow as much as banks will lend them. So it's a contest between finite government resources and unlimited market resources. And when speculators are convinced the fixed rate is unsustainable, they almost always win eventually. Through July and August of 1992, pressure on the Italian lira intensified. The Bank of Italy intervened repeatedly, spending billions of Deutschmarks from its reserves to buy lira and support the price. Italian interest rates were raised to make holding lira more attractive. But the fundamental problem remained. Italy's economy was weak, its fiscal position unsustainable, and the exchange rate looked overvalued. On September 13th, Italy was forced to devalue the lira by 7% within the ERM. The central parity rate was changed, acknowledging that the old rate had been unsustainable. This was supposed to relieve the pressure, but it had the opposite effect. It demonstrated that ERM parities could change. The political commitments could be abandoned when economic reality became too painful. If Italy could devalue, maybe other countries could too. George Soros had been watching all of this carefully. The Danish referendum, the pressure on the lira, the growing evidence that the ERM was straining under the weight of its internal contradictions, all of this fit his theoretical framework perfectly. Here was a system maintained by political will, but contradicted by economic fundamentals. Here were governments making absolute commitments. We will defend the parity that were being tested by markets. Here was a reflexive process beginning to unfold. Doubt leading to selling, selling creating pressure, pressure requiring intervention. Intervention depleting reserves increasing doubt. Soros's attention focused increasingly on the British pound. Of all the currencies in the ERM, sterling looked particularly vulnerable. Britain's economic situation was poor: recession, high unemployment, political pressure for lower interest rates. The exchange rate looked overvalued. British goods were expensive. The trade deficit was growing. The government's commitment, while repeatedly stated in the strongest terms, was relatively recent. Britain had only been in the ERM for less than 2 years, compared to other countries that had been members for over a decade. And crucially, Britain was not using the narrow 2.25% band but the wider 6% band, which suggested even the government recognised the difficulty of maintaining a tighter parity. Quantum Fund began building a short position in sterling, not all at once, not with a single dramatic trade, but gradually through the summer, accumulating the position, borrowing pounds and selling them for Deutschmarks and dollars. The scale was extraordinary. By September, Soros's position would total approximately $10 billion, several times the capital of Quantum Fund, achieved through massive leverage. This was not a cautious, hedged position. This was a massive, concentrated bet that the pound would devalue. But Soros was not alone. This is important to understand because the narrative often focuses on Soros as _5, suggesting a single individual taking on a government. The reality was that many hedge funds, banks, and currency traders were making similar assessments and taking similar positions. Soros's position was the largest and most concentrated, but the total amount of speculative selling pressure on sterling came from hundreds of different institutions and traders, all reaching similar conclusions about the pound's vulnerability. The market, in aggregate, was making a collective judgment that the ERM parity could not hold. The British government and the Bank of England were aware that pressure was building. They could see the pound weakening within its band, approaching the lower limit. They knew that intervention would soon be necessary, and they faced increasingly difficult choices. They could spend foreign exchange reserves buying pounds, but those reserves were limited, perhaps $40 billion total, which sounds like a lot but is small compared to the daily volume of currency trading. They could raise interest rates to make holding pounds more attractive, but this would worsen the recession and create political firestorms. They could realign within the ERM, accepting a lower parity for the pound, but this would be politically humiliating and would validate the speculator's strategy. Or they could leave the ERM entirely, abandoning the fixed exchange rate and letting the pound float, but this would be seen as a catastrophic policy failure. None of these options were good. Each involved costs that the government desperately wanted to avoid. So the response was to deny that any of them would be necessary, to insist that the parity would be defended, to project absolute confidence. Chancellor of the Exchequer, Norman Lamont, the minister responsible for economic policy, made repeated statements affirming the government's commitment. "We will do whatever is necessary to keep sterling in the ERM. The parity will be defended. There is no question of devaluation or leaving the system." These statements were meant to deter speculation by demonstrating resolve, but they had the perverse effect of raising the stakes. Having made such categorical commitments, backing down would be even more humiliating. Behind the scenes, there were also signals from Germany that undermined confidence in the system. The Bundesbank, while officially supporting the ERM, was clearly reluctant to sacrifice its anti-inflation mandate to help weaker currencies. Bundesbank President Helmut Schlesinger gave interviews suggesting that realignment of ERM parities might be necessary, that some currencies were overvalued. These comments, even when partly walked back, fueled speculation that Germany would not do whatever it took to defend the system, that countries with weak currencies might be on their own. By early September 1992, the pound was trading near the bottom of its permitted ERM band. The Bank of England was intervening regularly, buying billions of pounds to prevent it from breaking through the floor. Each intervention was costly. It depleted foreign reserves that would be needed if pressure intensified. And the interventions were not really working. The pound would stabilise briefly after intervention, then resume weakening as soon as the intervention stopped. The market sensed weakness, sensed that the government was fighting a losing battle. Political pressure within Britain was intensifying. The Labour opposition was attacking the government for maintaining high interest rates, while unemployment soared. Conservative backbenchers were grumbling that the ERM was strangling the economy. Business groups were pleading for rate cuts. The newspapers, particularly the Eurosceptic tabloids, were beginning to question whether defending the pound's ERM parity was worth the economic cost. Public opinion was shifting from seeing the ERM as a source of stability to seeing it as a straitjacket that prevented Britain from addressing its economic problems. The situation was becoming unsustainable. The government knew it, the Bank of England knew it, and increasingly the currency markets knew it. What remained was for the unsustainable to become actual, for the system to break, for the collision between political will and economic reality to reach its inevitable conclusion. The pound was trading at approximately 2 Deutschmarks and 80 Pfennigs, just barely above the 2.778 floor of its permitted band. Billions of pounds worth of reserves had already been spent defending this level. Interest rates were at 10%, high, but not high enough to convince speculators that the government would truly do whatever was necessary. The fundamental economic situation, recession, unemployment, and overvalued currency, remained unchanged. George Soros and other speculators were positioned. They had borrowed sterling, sold it, and were waiting for the break. They had done their analysis, formed their hypotheses about what would happen, and placed their bets. Now it was a matter of waiting, watching, being ready to adjust if the events unfolded differently than expected, but expecting that the logic of the situation would play out as theory predicted. The government could not hold the line indefinitely. The reserves would run out, or the political will would crack. The ERM parity would break. It was, in Soros's view, not a question of if, but when. And when it happened, when the pound was allowed to find its natural level, those who had bet against the artificial parity would profit enormously. The stage was fully set. The structural contradictions were in place. The positions were taken. All that remained was for the final act to play out, for the days in mid-September when the pressure would become overwhelming, when the government would try every available option and find them all inadequate, when reality would finally assert itself against political commitment. That moment was approaching. September the 16th, 1992, was just days away, though as the sun set each evening that week, few people knew they were about to witness one of the most dramatic financial events of the modern era. Let that anticipation rest lightly in your mind as you settle more deeply into comfort. The crisis is coming, but we'll approach it slowly, carefully, understanding each step as it unfolds. The morning of Wednesday, September the 16th, 1992, dawned grey and cool over London. For most of the city's 8 million residents, it was an ordinary day, commuters heading to work, children starting school, the routines of life proceeding as always. But in the dealing rooms of banks, in the offices of currency traders, in the emergency meetings already underway at the Treasury and the Bank of England, there was a sense that this day would be anything but ordinary. The pressure that had been building for weeks was about to reach a breaking point. The currency markets opened at 8 o'clock in the morning London time. Within minutes it was clear that the pressure on sterling was intense. Sell orders flooded in from around the world, from New York, from Tokyo, from Frankfurt, from London itself. The pound, which had closed the previous day barely above its ERM floor, immediately began falling toward that floor and threatening to break through it. This was the moment the Bank of England had been dreading, but also, perhaps, expecting. The Bank of England's response was immediate. At 8:30, just 30 minutes after markets opened, the bank began intervening in the foreign exchange markets. It started buying pounds with its reserves of Deutschmarks and dollars, trying to create enough demand for sterling to push the price back up, away from the danger zone at the bottom of the permitted band. The initial intervention was substantial, perhaps £2 billion worth in the first hour. For a brief moment, it seemed to work. The pound stabilised, even ticked slightly higher, but the relief was temporary. As soon as the intensity of intervention decreased, selling pressure resumed. The pound began falling again. Let's pause and think about what was happening in those dealing rooms, because the human dimension matters. Currency traders were watching screens showing the pound's price, updating moment by moment. They were on phones with clients, with colleagues in other time zones, with brokers executing trades. Some were following orders from superiors. Some were making independent decisions about whether to sell sterling, whether to hold positions, whether to take profits or increase bets. There was adrenaline, certainly the excitement of a major market event. But there was also calculation, risk assessment, the practical work of executing trades and managing positions. For the traders who were short sterling, who had borrowed and sold pounds betting on devaluation, the question was whether to hold those positions or take profits. The pound was falling, their bets were paying off, but how far would it fall? Would the Bank of England's intervention eventually work? Was this the final break, or just another moment of pressure that would pass? These decisions involved judgment, nerve, and substantial amounts of money. At the Bank of England and the Treasury, a different set of calculations was happening. Norman Lamont, the Chancellor of the Exchequer, was in constant contact with Bank of England Governor Robin Lee Pemberton and his deputy, Eddie George. They were monitoring the interventions, watching reserves deplete, trying to assess how much longer they could maintain the defence. The morning interventions had already cost billions from reserves. If this pace continued, they would run through available reserves within days or even hours. Something more dramatic was needed. The option they turned to was interest rates. If intervention alone wasn't working, perhaps making sterling more attractive through higher interest rates would convince the market that holding pounds made sense, that betting against the pound was dangerous. This was the nuclear option in some ways. Raising rates during a recession would devastate the already struggling economy, would enrage the Conservative Party's political base, would create enormous political costs. But the alternative seemed to be admitting defeat, leaving the ERM accepting humiliation. So the decision was made. At 11 o'clock in the morning, the government announced an emergency interest rate rise. The base rate, which had been 10%, was raised to 12%. A 2 percentage point increase announced outside the normal schedule, a clear signal of desperation and determination. The announcement was meant to shock the markets, to demonstrate that the government would do whatever it took, that speculating against sterling was a losing bet because the government would keep raising rates until the speculative attack broke. The market's response was not what the government hoped. There was a brief pause, a moment of uncertainty as traders absorbed the news and reconsidered their positions. But within an hour, it became clear that the rate rise was not going to be enough. The selling pressure resumed, the pound continued to weaken. Traders were making a judgment that the government could not sustain 12% interest rates for long, that the political and economic cost would force a reversal, that this was a bluff that could be called, and they were right. Think about the logic from the speculator's perspective. Yes, 12% interest rates made holding sterling more attractive, but 12% rates would also deepen the recession, increase unemployment, create mortgage defaults, devastate businesses. The political cost would be intolerable. Either the government would have to cut rates again soon, in which case the pound would collapse, or they would maintain the rates and the economy would collapse, in which case they would be thrown out of office and the next government would cut rates and the pound would collapse anyway. Either way, the pound was going to fall. The rate rise was a sign of weakness, not strength, because it revealed how desperate the government was. Inside the Treasury building on Whitehall, the mood was darkening. Lamont and his advisors were watching the market response to the rate rise with growing dismay. The intervention was not working. The rate rise was not working. They were running out of options. Reserves continued to drain away as the Bank of England kept buying pounds to prevent a complete collapse. The pound was trading just barely above the floor, held up only by massive, continuous intervention that was clearly unsustainable. Shortly after noon, another emergency meeting was convened. Lamont, Lee Pemberton, Eddie George, senior Treasury officials and representatives from No. 10 Downing Street, where Prime Minister Major was monitoring the crisis. The discussion was tense. Some argued for continuing the fight, raising rates even further, spending more reserves, demonstrating absolute commitment. Others argued that the battle was lost, that continuing to spend reserves was throwing good money after bad, that the sensible course was to accept reality and leave the ERM before even more damage was done. The decision was made to try one more dramatic gesture. If 12% interest rates were not enough, perhaps 15% would be. It was an extraordinary number, far beyond anything anyone had seriously contemplated. 15% interest rates would be economically catastrophic, but perhaps the very extremity of it would convince the markets that the government truly meant what it said, that they would accept any economic cost to maintain the ERM parity. At 12:30 in the afternoon, a second interest rate rise was announced. The base rate would go from 12% to 15%, effective immediately. This time, the market response was even more dismissive. Within minutes of the announcement, it was clear that not even 15% rates would save the pound. The selling continued unabated. If anything, the second rate rise made things worse, because it made the government's position look even more desperate, even more unsustainable. No one believed that Britain could actually maintain 15% interest rates. The announcement was not credible. It was a bluff that was immediately called. By early afternoon, the situation in the Treasury was approaching panic. Not panic in the sense of people running around screaming, but panic in the sense of growing recognition that all the available options had been tried and had failed, that the situation was spiralling out of control, that decisions made with such confidence just weeks earlier were collapsing in real time. The pound was still being held just above its floor, but only through intervention that was costing billions per hour. The reserves could not last much longer at this rate. And even if they could last, what was the point? The market had made its judgment. Political will, it turned out, could not override economic reality indefinitely. Through the afternoon, the discussions became more urgent, more focused on the endgame. The question was no longer whether to leave the ERM, but how to do it, when to do it, how to minimize the political and economic damage. There were arguments about timing. Some wanted to wait until after markets closed to make the announcement, to avoid further chaos during trading hours. Others argued for announcing immediately, ending the uncertainty. There were arguments about messaging. How do you frame a decision that amounts to admitting that your core economic policy has failed? How do you maintain any credibility when you've spent months saying this would never happen, and now it's happening. At approximately 3:30 in the afternoon, the decision was finalised. Britain would suspend its membership in the ERM. The pound would no longer be bound by the 2.778 floor. It would float freely, finding whatever level the market determined. The interest rates that had been raised to 12% and then to 15% would be brought back down. The crisis would end, not through victory, but through surrender. The announcement was not made immediately. There were logistical arrangements to handle, statements to draft, other European governments to notify. The trading day ended at 4:30 with the pound still technically in the ERM but clearly doomed. As London markets closed, the word began to leak. By evening, it was clear to everyone watching that something major was coming. At 7 o'clock in the evening, Norman Lamont emerged from the Treasury building to face the press. The scene was surreal. A gaggle of reporters and cameramen in the dark outside the Treasury, the Chancellor appearing under bright lights to make his statement. Lamont's demeanour was composed, professional, but the content of what he was saying was an admission of defeat. He announced that Britain was suspending its membership in the exchange rate mechanism. The pound would no longer be held to a fixed parity against other European currencies. Interest rates would be reduced from the emergency levels back to 10%, with further reductions to follow as appropriate. Lamont tried to frame the decision in the best possible light. He suggested that this was a temporary suspension, not a permanent exit, though no one really believed that Britain would rejoin the ERM. He noted that the fundamental economic policy of fighting inflation remained unchanged. He emphasised that leaving the ERM did not mean abandoning European integration more broadly. But the reality was clear to everyone watching. This was a humiliating defeat for the government, a repudiation of its economic strategy, a victory for the speculators who had bet against British policy. As Lamont was making his statement, the pound was already falling in after-hours trading. When Asian markets opened a few hours later, the decline would accelerate. By the time the dust settled in the days following, the pound would stabilise at around 2 Deutschmarks and 50 Pfennigs, roughly 8% below its ERM central parity, roughly 15% below where it had been defending just hours earlier. The devaluation that the government had insisted would never happen had happened. For George Soros and Quantum Fund, the outcome was extraordinarily profitable. The fund's $10 billion short position in sterling, built up over weeks, maintained through the final days of crisis, held with conviction despite the government's attempts to defend the parity, had paid off spectacularly. The exact profit is difficult to calculate precisely and has been debated, but credible estimates put Quantum Fund's profit from the sterling trade at approximately $1 billion. $1 billion earned in essentially a single day, from a trade that had lasted a few weeks from initial position to final unwinding. But Soros was not the only winner. Other hedge funds, banks, corporations, and traders who had been short sterling also profited. The total profits taken from the Bank of England's failed defence probably amounted to several $1 billion across all market participants. And the total cost to Britain, in terms of reserves spent, in terms of economic damage from the interest rate increases, in terms of political capital squandered, was even higher. Estimates suggest that the Bank of England spent approximately £3.3 billion trying to defend the parity on that single day, money that was effectively transferred to the speculators who sold sterling to the bank. The political fallout was immediate and severe. The Conservative government's economic credibility was shattered. They had made absolute commitments and been forced to break them. They had promised that ERM membership would bring stability and discipline. And instead it had brought chaos and humiliation. John Major remained Prime Minister. There was no immediate leadership challenge, but his authority was severely weakened. Norman Lamont would remain as Chancellor for a few more months, but would eventually resign under pressure. The Conservative Party, which had been seen as the party of economic competence, would struggle to regain that reputation. They would lose the next general election in 1997 by a landslide. For the European integration project, Black Wednesday was a warning sign. It demonstrated that the exchange rate mechanism was more fragile than its architects had hoped. That fixed exchange rates among countries with different economic situations and independent monetary policies could not be sustained against determined market pressure. Other countries would face similar pressures in the weeks following Britain's exit. The Italian lira would devalue further, the Spanish peseta and Portuguese escudo would come under attack. The ERM would eventually be reformed, the bands widened to make the system more flexible, but the confidence in the path toward monetary union was shaken. Yet looking back from our vantage point decades later, there's a deep irony in what happened. Black Wednesday, which seemed at the time like a catastrophic failure, turned out to be economically beneficial for Britain. Once freed from the ERM constraint, once able to set interest rates based on British economic needs rather than German needs, the British economy began to recover. Rates were cut, stimulating growth. The lower pound made British exports more competitive, improving the trade balance. The recession ended, unemployment began to fall, and Britain entered a period of sustained economic expansion that would last through most of the 1990s. The policy that had been defended so desperately, that had been presented as essential to British prosperity, turned out to be a constraint that was holding the economy back. Leaving it, however humiliating the circumstances, freed Britain to grow. This is what makes the story so rich with complexity, so resistant to simple morals. Was Soros a villain, profiting from Britain's misery? Or was he performing a useful market function, forcing an adjustment that needed to happen, preventing British policymakers from persisting with an unsustainable policy even longer? Was Black Wednesday a disaster or a blessing in disguise? The answer depends on your time horizon and your values. In the short term, it was a political catastrophe and a market crisis. In the longer term, it was an economic liberation. Both things can be true simultaneously, and both deserve our consideration as we try to understand what this moment meant. The morning after Black Wednesday, Britain woke to newspaper headlines that were brutal in their assessment. "White flag," declared one tabloid, showing a picture of Norman Lamont. "Defeated," said another. "Humiliation," screamed a third. The editorials were savage, attacking the government's competence, questioning how they could have staked so much on a policy that collapsed so completely, demanding accountability for the billions of pounds spent in a futile defence. The political damage was immediate and visible, splashed across every front page, discussed on every radio programme, dominating every conversation about politics and economics. For Norman Lamont, the Chancellor who had stood outside the Treasury the night before announcing Britain's suspension from the ERM, the personal cost was particularly high. He had been the face of the policy, the minister who had repeatedly promised that the parity would be defended, that there was no alternative to maintaining ERM membership. He had authorised the interest rate increases, approved the spending of billions in reserves, made the categorical statements that were now revealed as empty promises. Within the Conservative Party, calls began almost immediately for his resignation. How could he remain as Chancellor when his core policy had failed so spectacularly? Lamont would cling to office for several more months, but his position was untenable. He had lost credibility not just with the public, but with his own colleagues. When he finally resigned in May of 1993, his departure speech was bitter, criticising Prime Minister Major's leadership and suggesting that the government was in office but not in power. It was an inglorious end to a career that had seemed promising just months earlier. John Major, the Prime Minister, faced a different kind of damage. He could not easily be removed. Conservative Party rules made leadership challenges difficult, and there was no obvious alternative candidate who could unite the party. But his authority was severely diminished. The Conservative Party had won the April 1992 election, partly on the basis of economic competence, on the argument that they could be trusted to manage the economy better than Labour. Black Wednesday destroyed that argument. How could voters trust conservative economic management when they had just witnessed such a spectacular policy failure? The divisions within the Conservative Party, particularly over European integration, became much deeper and more bitter after Black Wednesday. Those who had always been sceptical of European entanglement felt vindicated. They had warned that tying British policy to European structures was dangerous, and events had proved them right. Those who had supported closer European integration felt betrayed and blamed for the disaster. The party fractured into pro-European and Eurosceptic factions that would fight increasingly nasty battles over the next several years. This internal warfare would weaken the government, make coherent policy making difficult, and contribute to the massive electoral defeat the Conservatives would suffer in 1997 when Tony Blair's Labour Party won a landslide victory. But here's where the story becomes interesting in ways that go beyond politics. While Black Wednesday was a political catastrophe for the Conservative government, it turned out to be economically beneficial for Britain. This is the great irony, the paradox that makes the episode so fascinating to economists and historians. The policy that was defended so desperately, that was presented as essential to British prosperity, was actually constraining the economy. And leaving it, however humiliating the circumstances, freed Britain to pursue policies more appropriate to its economic situation. Within days of exiting the ERM, British interest rates were cut. The emergency 15% rate that had been announced on Black Wednesday itself was immediately abandoned. Rates came down to 10%, then to 9%, then to 7%, then lower still over the following months. Each cut provided stimulus to the economy, making borrowing cheaper, encouraging investment and consumption, supporting the housing market. The recession that had gripped Britain since 1990 began to ease. Business confidence improved, hiring resumed, the economy started growing again, the lower pound helped too. At 2 Deutschmarks and 50 Pfennigs or thereabouts. British goods were suddenly more competitive in international markets than they had been at 2.95. British exports became cheaper for foreign buyers. Foreign goods became more expensive for British consumers, reducing imports. The trade deficit began to shrink. British manufacturers, who had been struggling to compete while the pound was strong, found new opportunities. This competitive devaluation, the very thing the government had insisted would be disastrous, turned out to be beneficial. By 1993, the British economy was growing robustly. By 1994, unemployment was falling. Through the mid and late 1990s, Britain would experience sustained economic expansion, with growth rates that were the envy of many other European countries. The performance was so strong that economists began speaking of the quote 9, non-inflationary consistent expansion, a period of stable growth with low inflation that seemed almost too good to be true. This success happened not despite leaving the ERM, but, at least partially, because of it. This created a painful situation for the Conservative government. Their policy had failed, but the failure had produced good outcomes. They had been proven wrong, but Britain was better off for it. How do you claim credit for economic success that resulted from abandoning your core economic strategy? The government tried to argue that the economic recovery vindicated their overall approach, that the fundamentals had always been sound, that leaving the ERM was a tactical adjustment rather than a strategic defeat. But voters weren't convinced. The memory of Black Wednesday, of the incompetence and humiliation, overshadowed the subsequent recovery. The Conservatives would pay the political price for their failure even as the economy thrived. The effects of Black Wednesday extended well beyond Britain. The entire exchange rate mechanism came under severe strain in the weeks and months following. If Britain could be forced out, if political commitments could be overwhelmed by market pressure, then other currencies might be vulnerable too. Currency speculators, emboldened by their success against sterling, turned their attention to other potentially weak ERM members. The Italian lira, which had already devalued once in mid-September, came under renewed pressure and was eventually forced out of the ERM entirely. The Spanish peseta and Portuguese escudo faced speculative attacks and had to devalue within the ERM. The Irish punt, despite Ireland's economy being in relatively good shape, faced pressure simply because it was perceived as vulnerable. Even the French franc, backed by an economy nearly as strong as Germany's, faced a serious attack in the summer of 1993 that required massive intervention by both the Bank of France and the Bundesbank to repel. The ERM crisis of 1992 and 1993 forced European policymakers to confront the fundamental problems with the system. The narrow bands that had been meant to impose discipline and create stability had instead created fragility. The requirement that countries with different economic situations maintain similar interest rates had created unsustainable strains. The political commitment to fixed parities, however strong, could not overcome economic fundamentals when those fundamentals diverged too far from the fixed rates. In August of 1993, the ERM was reformed. The permitted fluctuation bands were widened dramatically from 2.25% to 15%, above and below central parity rates. This made the system much more flexible, much less rigid, much less vulnerable to speculative attack. But it also made it much less meaningful. If currencies could fluctuate by plus or minus 15%, were they really fixed at all? The widening of the bands was an acknowledgement that the original conception of the ERM had been too ambitious, too rigid, unable to accommodate the diversity of economic conditions across Europe. Despite these crises and reforms, the broader project of European monetary integration continued. The Maastricht Treaty, despite the Danish rejection and subsequent uncertainty, was eventually ratified by all member countries. Denmark held a second referendum in 1993, and this time approved the treaty, having negotiated opt-outs from certain provisions. The path toward a single European currency proceeded, though the timeline was uncertain and the challenges were clear. The ERM crises had demonstrated how difficult monetary integration would be, but they had not fundamentally derailed the political commitment to the project. The euro would eventually be launched in 1999, with physical currency introduced in 2002. 11 countries initially adopted it, later expanding to 19. Notably, Britain chose not to join the euro, having learned from Black Wednesday that surrendering monetary sovereignty carried significant risks. The British public's scepticism about European integration, reinforced by the ERM experience, meant that no British government could seriously contemplate joining the single currency. This decision would have long-term consequences, contributing to Britain's eventual exit from the European Union entirely through the Brexit referendum of 2016. Black Wednesday's shadow, in some sense, extended across decades of British and European politics. For George Soros, the aftermath of Black Wednesday transformed his public profile. Before September 1992, he was well known within financial circles, respected as a successful hedge fund manager, but not a household name. After Black Wednesday, he became globally famous, the subject of countless newspaper articles, television profiles, and public discussions. The phrase, quote, 10 became attached to his name, a title that was both admiring and critical, depending on who was using it. In Britain, particularly among those who had suffered from the recession and the failed ERM policy, Soros was sometimes viewed as a villain, a rich speculator who had profited from Britain's misery, who had attacked the pound for personal gain, who had undermined democratic decision-making by forcing the government to abandon its chosen policy. The fact that leaving the ERM turned out to be beneficial didn't entirely eliminate this resentment. Making $1 billion in a day from currency speculation seemed, to many people, like an obscene profit extracted from ordinary citizens suffering. In other contexts, Soros was viewed more admirably, as a brilliant trader who had understood market dynamics better than governments did, who had recognized an unsustainable policy and profited from its inevitable collapse, who had performed a useful market function by forcing an adjustment that needed to happen. Among traders and in financial markets, his reputation was elevated even further. He had taken a massive position based on his analysis and been proven spectacularly right. This was what successful trading looked like at the highest level. Soros himself had complex feelings about the episode. In later interviews and writings, he acknowledged the ethical questions around profiting from currency crises. He noted that his actions hadn't caused the crisis. The crisis was created by the unsustainable structure of the ERM and the mismatch between political commitments and economic reality. He had simply recognized what was happening and positioned himself to profit from it. If he hadn't taken the position, someone else would have. The market forces would have operated the same way whether or not George Soros existed. But he also recognized that this defense, while logically sound, didn't entirely resolve the moral discomfort. People did suffer from the recession that the ERM policy had worsened. Businesses did go bankrupt, families did lose homes, workers did lose jobs. And while leaving the ERM ultimately helped Britain recover, that didn't change the fact that in the immediate aftermath there was pain and uncertainty. Soros profited enormously from a crisis that hurt many people, and however much economic logic might justify that profit, it still felt morally complicated. This moral complexity would influence Soros's later life and work. His increasing involvement in philanthropy, his support for democratic movements and open societies, his willingness to give away billions of dollars, all of this can be seen partly as a response to the ethical questions raised by his trading success. If you've made enormous sums from market speculation, from currency crises and economic dislocations, perhaps you have an obligation to use some of that wealth to help create a better, more just, more open world. This isn't to say his philanthropy was merely guilt-driven. His commitment to open society principles came from deep philosophical convictions developed long before Black Wednesday. But the vast wealth he accumulated, including from trades like sterling, certainly enabled and perhaps motivated his later philanthropic work. The hedge fund industry more broadly was validated and transformed by Black Wednesday and Soros's role in it. Hedge funds had existed for decades, but were still relatively marginal players in global finance in the early 1990s. They were lightly regulated, often secretive, and not well understood by the public or even by many financial professionals. Black Wednesday demonstrated that hedge funds could take positions large enough to influence or even overwhelm government policies. One fund, Quantum, had played a significant role in forcing Britain out of the ERM. This demonstration of power attracted both attention and capital. Investors who had been wary of hedge funds saw the extraordinary returns that Soros and others had achieved and wanted to participate. Wealthy individuals, pension funds, endowments all began allocating more money to hedge funds. The industry grew rapidly through the 1990s and 2000s, with assets under management increasing from tens of billions to trillions of dollars. The strategies pioneered by Soros, global macro investing taking large positions based on economic analysis, using significant leverage, were adopted and refined by new generations of traders. This growth brought increased scrutiny and criticism. The long-term capital management crisis of 1998, when a highly leveraged hedge fund nearly collapsed and threatened the financial system, raised questions about whether hedge funds were too risky, too powerful, too lightly regulated. The 2008 financial crisis, while not caused by hedge funds, involved significant losses at many funds and highlighted the systemic risks that large leverage positions could create. The debate about whether hedge funds serve a useful function, providing liquidity, enforcing market discipline, improving price discovery, or whether they're parasitic speculators destabilizing economies for private profit continues to this day. Black Wednesday also provided important lessons for economists and policymakers thinking about exchange rate systems and international monetary arrangements. The episode validated what economists call the quote 11 or the quote 12. the observation that a country cannot simultaneously maintain a fixed exchange rate, free capital mobility, and an independent monetary policy. You can have any two of these three, but not all three. Think about why this is true. If you have a fixed exchange rate and free capital mobility, then capital will flow toward whichever country has higher interest rates. If your country tries to maintain lower rates than the country you're pegged to, capital will flow out, your currency will weaken, and you'll be forced to either raise rates or abandon the fixed exchange rate. So you can't have independent monetary policy. Alternatively, if you want a fixed exchange rate and independent monetary policy, you need to control capital flows, prevent money from freely moving in and out of your country. And if you want free capital mobility and independent monetary policy, you need to let your exchange rate float. The ERM was an attempt to have all three: fixed exchange rates, free capital mobility within Europe, and some degree of monetary independence for each country. This was always going to be unstable. When economic conditions in different countries diverged too much, when Germany needed high rates and Britain needed low rates, the system could not hold. Black Wednesday was the inevitable result of trying to violate the impossible trinity. This lesson informed later policy decisions. When the euro was created, European leaders understood that you couldn't have a single currency, free capital mobility, and independent national monetary policies, so they eliminated national monetary policies, creating a single European central bank that sets policy for the entire eurozone. This solves the trilemma, but creates different problems. What happens when different eurozone countries need different policies? The euro crisis of 2010 onward demonstrated that this problem remains unresolved. Countries outside Europe also drew lessons from Black Wednesday. Many emerging market countries abandoned fixed exchange rate systems in favour of floating rates or managed floats with greater flexibility. The Asian financial crisis of 1997, when several Asian countries with pegged exchange rates faced speculative attacks similar to what Britain experienced, reinforced these lessons. Fixed exchange rates in a world of free capital mobility are vulnerable to exactly the kind of attack that Soros and others mounted against sterling. As we reflect on the aftermath of Black Wednesday, what emerges is a story of complexity and paradox, political disaster but economic success, humiliation that led to liberation, a failed policy that, by failing, allowed better outcomes than success would have permitted, a speculative attack that forced an adjustment that needed to happen, enormous private profits from public crisis, moral ambiguity throughout. Soros wasn't simply a hero or a villain. The government's defence wasn't simply foolish or noble. The outcomes weren't simply good or bad. Reality, as always, resists simple narratives and clear moral judgments. The episode remains endlessly fascinating precisely because it doesn't fit neatly into categories, because it challenges our assumptions about markets and governments, because it demonstrates both the power and the limits of political will and economic logic. Let these complexities rest in your mind as we continue to explore what George Soros did with his wealth and his life after his most famous trade. Black Wednesday made George Soros wealthy beyond what most people can easily comprehend, but he was already wealthy before that trade, and he would continue to accumulate wealth through the 1990s and beyond. Quantum Fund continued producing extraordinary returns through the decade, with Soros remaining actively involved in investment decisions, still testing his theories about reflexivity against market reality, still taking large positions when his analysis suggested significant opportunities. The $1 billion from the sterling trade was spectacular, but it was one success among many, part of a pattern that had been unfolding for decades and would continue. Through the mid-1990s, Soros and his funds invested globally, taking positions in currencies, stocks, bonds, commodities, anywhere his macro analysis suggested mispricing or unsustainable trends. The investments were not always successful. There were losses, sometimes substantial ones, quarters when the fund's returns were negative, but the pattern that had characterized his entire career continued. The gains in winning periods more than compensated for losses in losing periods, and the cumulative effect was wealth creation on an almost unimaginable scale. Then came 1997, and another currency crisis that would involve Soros's name, though in more controversial circumstances than Black Wednesday. This was the Asian financial crisis, a catastrophic economic collapse that swept through Thailand, Indonesia, South Korea, Malaysia, and other Asian economies. The crisis began in Thailand in July of 1997 when the Thai baht, which had been pegged to the US dollar, came under speculative pressure similar to what sterling had faced in 1992. Thailand's central bank tried to defend the peg, spending billions in reserves, but eventually was forced to abandon it. The baht collapsed, falling 40% in a matter of months. The crisis spread rapidly through the region. Indonesia's rupiah fell even more dramatically. South Korea, one of Asia's largest economies, faced a full-scale financial crisis requiring an International Monetary Fund bailout. The human costs were enormous. Businesses collapsed, unemployment soared, middle-class families saw their savings evaporate, poverty increased dramatically. Across Asia, the boom years of rapid growth and rising prosperity gave way to recession, political instability, and social upheaval. Soros and other hedge funds had taken positions betting against some Asian currencies, believing they were overvalued and unsustainable. This was similar to the sterling trade, identifying fixed exchange rates that didn't reflect economic fundamentals, taking short positions, profiting when the pegs broke. But the context was different. Britain was a wealthy country that weathered Black Wednesday, and actually benefited economically from leaving the ERM. The Asian countries were developing economies where currency collapses led to severe hardship for hundreds of millions of people. The moral optics were much worse. Mahathir Mohamad, the Prime Minister of Malaysia, launched a vitriolic attack on Soros, blaming him personally for the crisis. In September 1997, Mahathir gave speeches calling Soros a criminal, accusing him of deliberately destroying Asian economies for profit, suggesting that the crisis was a conspiracy by Western speculators to undermine Asian prosperity. The attacks had anti-Semitic undertones, with references to Soros's Jewish background and suggestions of global conspiracies. Mahathir's rhetoric was inflammatory and inaccurate. The Asian crisis was caused by structural economic problems, excessive borrowing, weak financial systems, not by speculators, but it resonated with many Asians who were suffering and looking for someone to blame. Soros responded publicly, defending currency speculation as a legitimate market activity, arguing that speculators don't cause crises but expose underlying weaknesses, noting that Malaysia's economy had its own serious problems that had nothing to do with foreign speculators, but the controversy damaged his reputation, particularly in Asia. The man who broke the Bank of England image, which had been somewhat admiring or at least neutral, was overlaid with the man who destroyed Asian economies, which was much more negative. The fact that Soros's funds had actually not been heavily involved in attacking the Malaysian ringgit specifically didn't matter. He had become the symbol of predatory speculation in the public imagination. The following year, 1998, brought Soros's most significant trading loss. Russia, which had been struggling economically through its transition from communism to capitalism, faced a financial crisis. The Russian government defaulted on its debt, and the ruble collapsed. Quantum Fund had significant positions in Russian securities, betting on economic recovery and reform. When the crisis hit, those positions lost enormous value. The fund lost approximately $2 billion on Russia in a matter of weeks, not enough to threaten the fund's survival, given its total assets, but still a staggering loss that demonstrated that even Soros's analysis could be wrong, that reflexivity theory didn't guarantee success, that losses were always possible when taking large, leveraged positions. These experiences, the Asian crisis controversy and the Russian losses, seemed to affect Soros's approach to investing and to life more broadly. He was in his late 60s by this point, had been actively managing money for nearly 3 decades, had accumulated wealth estimated in the billions of dollars. The question of what to do with that wealth, what his legacy would be beyond trading success, became increasingly important to him. Soros had actually been engaged in philanthropy for years before Black Wednesday made him globally famous. As early as the 1970s, he had begun thinking about how to use his wealth to support the open society principles he had learned from Karl Popper. In 1979, he established his first foundation, providing scholarships to black students in South Africa under apartheid. Through the 1980s, he expanded his philanthropic work, particularly in Eastern Europe, supporting dissidents and democratic movements in communist countries. But it was after the fall of communism in 1989 and 1990 that Soros's philanthropy dramatically expanded. The collapse of the Soviet Union and the transition of Eastern European countries from communism to democracy created enormous opportunities and challenges. These societies needed to build democratic institutions, market economies, civil society organizations, free media, all the infrastructure of an open society that had been suppressed under communist rule. Soros saw this as a historic opportunity to support the values he believed in, and he committed enormous resources to the effort. The Open Society Foundations, as his philanthropic network came to be called, grew to operate in dozens of countries, spending hundreds of millions of dollars annually on programs supporting democracy, human rights, education, public health, criminal justice reform, and countless other causes related to building and maintaining open societies. The scale was unprecedented for a private philanthropist. By the early 21st century, Soros had donated over $32 billion to his foundations and related causes, the vast majority of the wealth he had accumulated through decades of investing. The work was diverse and global. In Eastern Europe and the former Soviet Union, open society foundations supported democratic transitions, helped build independent media, funded education reform, supported Roma communities facing discrimination. In Africa, they funded public health programs, supported legal reform, worked on governance and anti-corruption initiatives. In the United States, they supported criminal justice reform, immigrant rights, drug policy reform, and progressive political causes. Everywhere, the underlying philosophy was Popper's vision of open society, plural, tolerant, self-critical, based on reason and evidence rather than ideology or authority. Some of this work was uncontroversial. Few people object to funding education or public health, but much of it was politically charged. Supporting democratic movements meant opposing authoritarian governments, which made Soros an enemy of regimes from Russia to Hungary to various developing countries. Supporting progressive causes in the United States made him a target of conservative politicians and media, who portrayed him as a dangerous radical, trying to impose a liberal agenda. His support for drug policy reform, including decriminalization of marijuana and harm reduction approaches to drug addiction, was controversial across the political spectrum. Soros also became directly involved in politics in ways that went beyond philanthropy. He was a major donor to Democratic candidates and causes in the United States, particularly after 2000 when he became strongly opposed to President George W. Bush. He donated millions to groups working to defeat Bush's re-election in 2004. When Barack Obama was elected in 2008, Soros was seen as having been influential in supporting progressive policies. His political involvement made him a lightning rod for criticism from conservatives who accused him of trying to buy political influence, of funding radical movements, of undermining American sovereignty and values. This political involvement also made Soros the target of conspiracy theories and anti-Semitic attacks. Because he was wealthy, Jewish, and politically active on the left, he became a focal point for anti-Semitic narratives about Jewish control of finance and politics. Conspiracy theories claimed he was funding everything from Black Lives Matter protests to migrant caravans to colour revolutions overthrowing governments. These theories were demonstrably false or wildly exaggerated, but they spread widely on the internet and were sometimes amplified by politicians and media figures who should have known better. The anti-Semitism directed at Soros was particularly bitter, given his history. He had survived the Holocaust, had witnessed the destruction that anti-Semitic ideology could produce, had spent his life supporting open societies partly as a bulwark against the kind of closed, authoritarian thinking that enabled the Holocaust. Yet now, in his 70s and 80s, he faced anti-Semitic attacks from both far-right groups and from some leaders of authoritarian governments who portrayed him as a sinister globalist manipulating world events. The attacks were painful and dangerous. In 2018, a bomb was mailed to his home by a right-wing extremist, though it was intercepted before causing harm. Through these controversies, Soros continued to write and speak about the ideas that had guided his life. His later books, The Crisis of Global Capitalism in 1998, The Bubble of American Supremacy in 2003, The Age of Fallibility in 2006, and others, applied his philosophy of reflexivity and fallibilism to politics, international relations, and social issues beyond finance. The books were sometimes praised as insightful, sometimes criticised as naive or ideological, but they demonstrated his continued engagement with the big questions about how societies should be organised, how we can improve human welfare, how we can build a more rational and humane world. The 2008 financial crisis, the worst economic downturn since the Great Depression, brought Soros back into the public conversation about markets and regulation. His analysis of the crisis was rooted in reflexivity theory. He argued that the housing bubble and subsequent collapse were classic examples of boom-bust sequences driven by self-reinforcing processes where rising home prices justified more lending, which drove prices higher until the fundamentals could no longer support the bubble and the reversal began. He advocated for stronger financial regulation, for recognition that markets are inherently unstable and require government oversight, for policies to prevent future crises. He also put his money where his mouth was, reportedly making over $1 billion by betting against the housing market and financial stocks as the crisis unfolded. Once again, he profited enormously from crisis, which raised the same moral questions that had surrounded his earlier currency trades. Was he performing a useful function by betting against an unsustainable bubble, or profiting from others' misery? The answer, as before, depends on your perspective and values. By 2011, Soros had largely stepped back from active money management. Quantum Fund was converted from a hedge fund taking outside investors to a family office managing only Soros family wealth. This reduced regulatory burdens and allowed Soros to focus more on his philanthropy and less on meeting the expectations of outside investors. He was in his 80s, still intellectually engaged but no longer interested in the day-to-day intensity of running a major hedge fund. The transition marked the end of an era. Quantum Fund had been one of the most successful hedge funds in history, producing average annual returns estimated at 30% over several decades, but that chapter was closing. Soros's personal life had been complex through these years. His second marriage to Susan Weber ended in divorce in 2005 after 22 years. They had 2 sons together, Alexander and Gregory, who would both eventually become involved in philanthropic work. Soros had 3 children from his first marriage as well, Robert, Andrea, and Jonathan, and his relationships with all his children were reportedly close despite the divorces and the demands of his work. In 2008, at age 78, he married for a 3rd time to Tamiko Bolton, who was 41. The marriage raised eyebrows given the age difference, but appeared to be happy and stable. His legacy in finance is secure. He was one of the most successful investors in history, generating returns that few could match over sustained periods. He pioneered global macro investing, demonstrating that thinking about entire economies and currencies could be as profitable as analysing individual companies. He proved that philosophical sophistication, understanding reflexivity, fallibilism, the nature of knowledge and reality, could translate into practical trading success. Numerous successful investors cite Soros as an influence, and his theories about market dynamics continue to be studied and debated. His legacy in philanthropy is equally significant. $32 billion donated over a lifetime represents an extraordinary commitment to using private wealth for public purposes. The Open Society Foundations have supported countless initiatives around the world, from helping build democratic institutions in Eastern Europe to criminal justice reform in the United States to public health programs in Africa. Whether all this spending has been effective, whether it has achieved its goals, whether some of it has been wasted or counterproductive, these are fair questions that deserve careful analysis. But the scale of the commitment, the consistency of the underlying philosophy, and the genuine attempt to make the world more open, more just, more rational cannot be dismissed. His philosophical legacy is more uncertain. Reflexivity theory has not been fully accepted in academic finance or economics, where equilibrium models still dominate, but it has influenced how many practitioners think about markets, how they understand booms and busts, how they recognize the limits of their own knowledge. The broader Popperian framework of fallibilism and open society, while not unique to Soros, has been powerfully articulated and promoted through his writing and philanthropy. In an era of rising authoritarianism, of increasing confidence in absolute ideologies, of declining faith in reason and evidence-based decision-making, the principles Soros championed feel both more important and more endangered. As Soros entered his 90s, he remained actively engaged in philanthropy and public discourse, though he gradually handed more operational control to others, including his son Alexander, who became chair of Open Society Foundations. He continued to speak out on political issues, to fund causes he believed in, to warn about threats to democracy and open society. His enormous wealth, still in the billions despite giving away so much, ensured his voice would be heard, though whether it would be heeded was another question. The story of George Soros's later life shows us something about the relationship between wealth, power, and values. He used markets to accumulate extraordinary wealth, then used that wealth to promote the open society principles he believed markets required to function well. He was a capitalist who recognized capitalism's limitations and instabilities, a speculator who advocated for financial regulation, a wealthy man who supported redistribution and social justice. These seeming contradictions reflect a sophisticated understanding that markets are tools, not ideologies, that they can serve human flourishing, but only within frameworks that prevent their excesses and ensure their benefits are broadly shared. Whether Soros succeeded in living out these principles, whether his actions matched his stated values, whether his legacy will be judged positively by history, these questions remain open, subject to debate, dependent on perspective and values that different people will weight differently. What's clear is that he grappled seriously with these questions, that he didn't simply accumulate and hoard wealth, but tried to use it for purposes beyond personal comfort, that he remained intellectually engaged with the big questions about how we should live and what kind of world we should build. That engagement, that refusal to be satisfied with material success alone, that insistence on thinking philosophically about finance and politically about philosophy, these are perhaps the most admirable aspects of a complex and controversial life. As we've journeyed through this story together, from George Soros's childhood survival in occupied Budapest, through his philosophical education and trading career to Black Wednesday and beyond, certain themes have emerged repeatedly, certain questions have lingered without easy answers, certain lessons have presented themselves for our consideration. Let's take some time now to reflect on what this story teaches us, what it reveals about markets and certainty, about knowledge and power, about the relationship between ideas and reality. There are no definitive conclusions here, no simple morals to extract, but there are insights worth contemplating, questions worth sitting with. Black Wednesday teaches us something fundamental about the limits of political will when it confronts economic reality. the British government made absolute commitments. We will defend the ERM parity. We will maintain sterling at 2.95 Deutschmarks. There is no alternative. These commitments were sincere, backed by enormous resources. Defended with billions of pounds in reserves and dramatic interest rate increases. The political will was genuine and strong, yet it was not enough. Economic fundamentals, the mismatch between what Germany needed and what Britain needed, the overvaluation of sterling, the structural contradictions in the ERM system could not be overridden by political commitment alone. Reality eventually asserts itself, regardless of how much power and determination is marshalled against it. This doesn't mean political will is meaningless. The British government held the line much longer than might have been expected, demonstrating that determined intervention can delay market forces, and in other contexts political commitments have been sustained successfully, currency pegs have been maintained, policies have worked despite scepticism, but there are limits. When the gap between political commitment and economic fundamentals becomes too large, when the costs of maintaining the commitment become too high, when market participants collectively judge that the commitment is unsustainable, the commitment breaks. This is simultaneously humbling. Governments are not all powerful and important to understand for anyone thinking about policy, markets, or the nature of power itself. The episode also illuminates the role of speculators in markets and raises difficult questions about whether that role is beneficial or harmful. From one perspective, speculators like Soros performed a useful function on Black Wednesday. They identified an unsustainable policy, bet against it, and forced an adjustment that needed to happen. Britain was suffering under a policy, maintaining ERM membership with an overvalued exchange rate that was worsening its recession. By forcing Britain out of the ERM, speculators inadvertently, or perhaps intentionally, depending on how charitable you want to be, helped Britain adopt policies more appropriate to its economic situation. The eventual recovery and growth of the British economy in the years following Black Wednesday suggests that leaving the ERM was economically beneficial. In this view, speculators are a disciplining force, preventing governments from persisting in misguided policies, enforcing a kind of market rationality that serves the broader public interest. From another perspective, speculators profited enormously from a crisis that caused real suffering. The high interest rates imposed to defend the pound hurt businesses and homeowners. The uncertainty and chaos of Black Wednesday itself disrupted the economy. The political crisis weakened governance at a critical time. Even if leaving the ERM ultimately proved beneficial, the manner of leaving, forced by speculative attack rather than chosen deliberately, was traumatic and costly. And the profits extracted by speculators, billions of dollars transferred from public resources to private hedge funds, can be seen as a kind of tribute paid to those who correctly bet against government policy. Is this really a function that deserves such lavish reward? Soros himself wrestled with these questions, acknowledging the moral complexity while defending the legitimacy of his actions. He argued that he didn't cause the crisis. The crisis was inherent in the unsustainable ERM structure. He was simply recognizing reality and positioning himself to profit from the inevitable adjustment. If he hadn't taken the position, other traders would have. The market forces were operating independently of any single participant. This defense is logically sound but emotionally unsatisfying. It's true that Soros didn't create the structural problems that made Black Wednesday inevitable. It's also true that he profited enormously from those problems. Both things can be true simultaneously, and the moral judgment depends on how you weight different values: market efficiency versus social solidarity, informed recognition of reality versus perceived profiteering from crisis. The story also provides a vivid illustration of reflexivity in action, demonstrating how Soros's philosophical framework actually operated in a concrete situation. The ERM crisis was reflexive in exactly the ways Soros's theory predicted. Market participants formed views about whether the pound could be defended, views based on analysis of fundamentals, political will, reserve levels, interest rate tolerance. Based on those views, they took actions, selling pounds, building short positions. Those actions created pressure that weakened the pound, depleted reserves, forced interest rate increases. The weakening and the defensive measures validated the initial skepticism, reinforcing the view that the parity was unsustainable. More selling followed, more pressure built, in a self-reinforcing cycle that overwhelmed the government's defences. The perception that the pound would devalue helped cause the devaluation, making the perception self-fulfilling. This is the essence of reflexivity, the two-way connection between thinking and reality, where participants' views influence the situation and the situation influences their views, creating feedback loops that can drive boom-bust sequences. Black Wednesday was the bust phase of a sequence that had begun with Britain's entry into the ERM, a decision based partly on wishful thinking about political will overcoming economic constraints. The theory predicted that such misconceptions eventually get corrected, that reality reasserts itself, and that the correction can be sudden and dramatic when the gap between perception and reality has grown too large. Events unfolded almost exactly as the theory suggested they would. For those thinking about exchange rate systems and international monetary policy, Black Wednesday reinforced several important lessons. Fixed exchange rates in a world of free capital mobility are extraordinarily difficult to maintain when economic conditions diverge. The impossible trinity or trilemma, the observation that you cannot simultaneously have a fixed exchange rate, free capital mobility, and independent monetary policy, is not just a theoretical construct but a practical constraint that policymakers ignore at their peril. The ERM tried to square this circle by having quasi-fixed rates with narrow bands and coordination among central banks. But when German and British economic needs diverged dramatically after German reunification, the coordination wasn't sufficient and the quasi-fixed rates couldn't hold. The lesson many countries drew from Black Wednesday and subsequent currency crises was to abandon fixed exchange rates in favour of floating rates, or at least much more flexible arrangements. Floating rates provide an adjustment mechanism. If your economy needs different monetary conditions than another country, your currency can appreciate or depreciate to reflect that difference. You give up the stability and predictability of fixed rates, but you gain flexibility and reduce vulnerability to speculative attacks. This shift toward floating rates became the dominant model for most countries, though some regions, most notably Europe with the euro, chose instead to eliminate separate currencies entirely, thereby avoiding the exchange rate question by having a single currency. The euro's creation and evolution can be seen partly as a response to the ERM's failures. If maintaining fixed rates among separate currencies was too difficult, perhaps the solution was to have a single currency with a single central bank. This solved the trilemma by eliminating national monetary independence. Eurozone countries gave up their ability to set their own interest rates in exchange for having a truly fixed, or rather unified, currency. Whether this has worked is a subject of ongoing debate, particularly after the Eurozone crisis that began in 2010. But it represents one way of addressing the problems that Black Wednesday revealed. Black Wednesday also teaches us about knowledge, uncertainty, and decision-making under conditions where perfect information is impossible. The British government faced an impossible epistemological position. They needed to know whether the ERM commitment could be sustained, but the sustainability depended partly on whether people believed it could be sustained, and that belief was influenced by the government's own actions and statements. There was no objective fact of the matter independent of market participants' perceptions and actions. This is what Soros meant by participant bias. When you're part of the situation, you're trying to understand. When your understanding affects the situation, perfect knowledge is impossible. The proper response to this predicament from a Popperian perspective is not to claim certainty but to form testable hypotheses, remain open to evidence that contradicts those hypotheses, and be willing to change course when reality doesn't conform to expectations. The British government instead chose absolute commitment. categorical statements that left no room for adjustment. This made sense politically. Showing any uncertainty would have invited immediate attack, but it also locked them into a position that became increasingly untenable as evidence accumulated that the policy wasn't working. A more fallibilist approach might have been to acknowledge uncertainty, to present the ERM commitment as conditional on various factors, to preserve flexibility for adjustment. But such an approach might have invited the very speculative attack it was trying to prevent. This is the cruel paradox. Admitting uncertainty makes you vulnerable, but claiming certainty when you don't have it can lead to even more spectacular failure when reality contradicts your claims. For Soros, the lesson was different but related. He formed a hypothesis. The ERM parity was unsustainable, based on his analysis of fundamentals, political constraints, and reflexive dynamics. He tested that hypothesis by taking a position. He watched carefully to see if events unfolded as expected. He was prepared to reverse course if evidence suggested he was wrong, but the evidence consistently supported his thesis. When the pound broke, his hypothesis was validated and his position was enormously profitable. This is fallibilism in practice. Hold your beliefs lightly, test them against reality, be prepared to be wrong, and recognize that being less wrong than others is often enough for success even if you're not perfectly right. The question of whether Soros' success means his theory is correct is philosophically interesting. Reflexivity theory is not a precise predictive model. It doesn't generate specific forecasts that can be tested rigorously. It's more a framework for thinking about how markets operate, a lens for recognizing patterns and vulnerabilities. Soros' trading success suggests the framework is useful, that it captures something true about market dynamics. But it doesn't prove the theory in a scientific sense. Other traders using different frameworks have also been successful. Markets are complex enough that multiple approaches can work, at least for some people some of the time. What reflexivity offers is not certainty but insight, not a guaranteed method for making money, but a way of understanding why markets behave as they do, why boom-bust sequences occur, why political commitments sometimes fail to override economic reality. Reflecting on Soros as a figure, what emerges is complexity and contradiction. He was a brilliant analyst who understood markets deeply, yet he also experienced significant losses when his analysis was wrong. He was a speculator who profited from crises, yet he also gave away the vast majority of his wealth to support causes he believed would make the world better. He was an advocate for open society and rational discourse, yet he was also a political partisan who supported specific parties and candidates. He survived totalitarianism and dedicated his life to opposing authoritarianism, yet he was accused by authoritarian leaders of being an authoritarian himself, manipulating societies for his own ends. He promoted fallibilism and intellectual humility. Yet he often spoke with great confidence about political and social issues where certainty was impossible. These contradictions don't cancel each other out or resolve into a simple judgment of good or bad. They reflect the reality that people are complex, that actions can have multiple meanings and consequences, that the same person can embody both admirable and troubling qualities. Soros's life demonstrates that philosophical sophistication and market success can coexist, that wealth and social commitment are not incompatible, that someone can genuinely believe in open society principles while also being controversial and divisive. His story resists simple narratives, which is perhaps fitting for someone whose philosophy emphasized that simple narratives are usually wrong, that reality is more complex than our theories capture, that certainty is an illusion we should abandon in favor of testing our ideas against evidence and revising them when necessary. The enduring relevance of Black Wednesday and Soros's role in it lies not in the specific details. Few of us will ever short $10 billion worth of currency, but in what it reveals about how the world works. It shows us that markets and politics interact in complex ways, that economic forces can overwhelm political commitments, that uncertainty is fundamental to decision-making, that profits and losses are not just financial, but also moral and political. It demonstrates that understanding how people think and how their thinking affects reality can be extraordinarily valuable, both intellectually and practically. It reminds us that history is made not just by large impersonal forces, but also by individuals making decisions based on their analysis and convictions, and that those decisions can have consequences far beyond what the individuals intended or imagined. As you lie there, perhaps feeling sleep approaching or having drifted off and returned, let these ideas settle in your mind without forcing them into neat conclusions. The story of George Soros and Black Wednesday doesn't have a simple moral. It offers instead an invitation to think about uncertainty, about the limits of knowledge, about how we make decisions when we can't be certain, about the relationship between markets and governments, about wealth and responsibility, about ideas and their consequences. These are questions without final answers, themes that recur across different contexts and times, puzzles that each generation must grapple with anew. The specific details of sterling in 1992 matter less than the general principles they illuminate, and those principles remain relevant to anyone trying to understand how economies work, how decisions get made under uncertainty, how individual understanding and action can shape collective outcomes. Rest with these thoughts. Let them drift through your consciousness like clouds across an evening sky, and prepare to release them as we move towards sleep and stillness. And so we've travelled together through this story, from the streets of wartime Budapest to the trading floors of London, from survival to philosophy to extraordinary wealth to questions about meaning and legacy. We've explored how one person's understanding of uncertainty, of the gap between perception and reality, could translate into both market success and a lifelong commitment to open society. We've sat with the complexity of it all, the moral questions, the economic insights, the human contradictions. If you've drifted away during our journey, that's exactly as it should be. These stories exist to help you rest, to give your mind something to contemplate as sleep approaches, to remind you that the world is vast and complex and filled with people trying to make sense of it, just as you are. The story of markets and governments, of certainty and doubt, of wealth and purpose, these continue beyond George Soros, beyond Black Wednesday, beyond any single moment. You're part of this ongoing story, this human attempt to understand and navigate an uncertain world. Tomorrow you'll wake and face your own uncertainties, make your own decisions with imperfect knowledge, test your own understanding against reality. But tonight, let all of that go. Let your breathing slow and deepen. Let the questions rest unanswered. Let yourself drift into sleep, knowing that uncertainty is not weakness but wisdom, that questions can wait, that rest is what you need now. Sleep well, dream gently, good night.